CPI surge. US inflation for June jumps the most since 2008. Jay Powell is set for a grilling on Capitol Hill. Disappointment on Wall Street. JP Morgan and Goldman shares fall after suffering worse than expected slumps in fixed income trading. Today is the turn of Bank of America, Citi and Wells Fargo. Plus, Apple is looking to boost iPhone output this year by up to 20%. It's also planning a partnership with Goldman on a buy now, pay later service. Good morning, everybody. Lots to talk about this morning as we are just 15 or so seconds away from the start of the European trading day. And European equity market futures point to the downside, down by around 2 or 3/10%. In fact, US equity market futures a little flatter, a little more muted. But actually, just having said that, things worsened a little in the last 5 minutes or so. Now down on Dow and E-mini futures, down around 0.25%. NASDAQ futures a little bit flatter. Still dealing with our thoughts on US CPI perhaps, and as we talked about a lot in the last hour, perhaps didn't see a great deal of initial reaction. We did see some movement in the dollar. We did see some curve flattening, as we were talking about with Mark. But then things started to get more complicated as we added in a slightly disappointing 30-year auction and yields increased at the long end. So there was sort of complex reaction to what we heard on CPI. We'll have PPI data, so factory floor prices in the US out later on today. We'll see how that number goes down. We'll see whether that number comes in higher than had been anticipated by economists, as that seems to have been something of a theme of late. So European equity markets just getting into their stride. We had time, of course, to price in some of that reaction to the US CPI print yesterday. We also have some new information in the shape of the UK CPI number this morning. That came in higher than anticipated as well. So certainly keeping up with that higher inflation theme. This is the picture then for European equity markets right now. We're actually down by 0.5% on the FTSE 100, down by 0.5% on the Spanish IBEX, and 0.4% on some of the other major markets here in Europe. So some fairly substantial moves to the downside. European equity markets then opening a little bit lower this morning. US headline inflation prices accelerated to 5.4% year on year. That was in the month of June, and that was the most since 2008. If you took some other measures of inflation, you certainly got back to the early 90s in terms of your comparisons. Let's get the thoughts of Karim Chedid, who is BlackRock Head of Investment Strategy for iShares EMEA, and joins us now. Karim, very nice to speak to you. So weigh in with your thoughts on the inflation picture then. What do we learn when we see inflation prints coming in much higher than had been anticipated? It still doesn't maybe tell us just how long that inflation is going to hang around for, or does it?
Thanks for having me, Anna. And you're right. I think there's two things here happening with the inflation readings. There's the part of the inflation pickup that we can put down to the transitory nature of the reopening of the economy, and we're seeing this in the pickup in the goods prices, especially where supply seems to be short in terms of meeting the pickup in demand that we're seeing with the economic restart. But then there is also the services part, and basically the part of the inflation pickup that you can't just put down to the COVID-related basket or the transitory effects. And that part is probably a bit less transitory, so can stick around for a bit longer. And what we're seeing here with the inflation reading yesterday is a bit of both. A lot of it can be put down to the transitory effects, such as the used car sales. We saw it with the big pickup, 10% pickup in those prices. But also there is a part that could stay around.
And so do you see any big change, Karim, in some of the structural factors that drove inflation to be as low as it was in the last 10, 15 years or so, 10 years, Karim. I mean, I'm thinking about globalization, I'm thinking about transparency of pricing afforded to consumers by greater use of technology and being able to search for prices online. Does any of that change? Maybe the globalization drive, maybe that changes things.
Yeah, I think in short, it's too soon to tell if the structural drivers have completely changed, but there are signs that perhaps peak globalization is behind us. So the deglobalization effects you'd expect would have the opposite effect on inflation that globalization had. So here I'm thinking more localized supply chains. Those should lead to higher input costs for companies, which, if they pass on to consumers, would lead to more inflation. Too soon to tell if we're seeing this in the near-term inflation readings, but as we zoom out and we look to the two-year view, two-year out view, more the midterm, we do see some of those structural changes, especially with the deglobalization effect, that could help inflation stick around a bit longer.
Let me ask you about, I mean, clearly many investors watching what happens with inflation, and we're seeing reaction to it in the curve, in the Treasury curve, and this has a big impact on certain sectors, not least of which banks. What do you see in the banking sector at this point? Are we going to see further flattening of the curve and further difficult times for the banking sector, or will we see some steepening there and therefore an increased ability for the banking sector to make money, Karim? What does the banking sector look like to you?
So in the near term, we've been seeing, some more, as you said, a bit of volatility in the curve and in the reaction to the inflation readings, both the last month's upside surprise as well as yesterday's upside surprise. But at these levels, in terms of the yield curve and yield levels, we have gone further underweight on duration in the US and in our mid-year asset allocation views, mid-year guide. With that context in mind, I think banks are one of the more cyclical sectors that could be well positioned, especially in both the US as well as Europe, at least on a tactical level. They could be well positioned in this context, and in fact, when I bring it back to some of the investor trends that we've been seeing, like ETP flows, financial sector and specifically banks has been the sector that has gathered the most amount of inflows in the ETP industry year to date. So even investors have started to position for this uptick.
One of the other themes, I suppose, or investment themes that you've been talking about at BlackRock for some time, and I know is a focus, Karim, is around flows into ESG. Give us the latest details then on just how much the market is shifting towards ESG products, and what you're doing at BlackRock to make sure that things that are labeled ESG really are as ESG as they claim to be.
Yeah, I mean, this is very much a theme in Europe, in the EMEA region, as well as globally, but especially in EMEA. We're seeing some really accelerated, back to the structural themes that we're discussing, we're seeing some really accelerated structural trends in this space. So if I give you a statistic, in 2021, 47% of all inflows that have gone into the ETP industry in EMEA have been into sustainable exposures. And that is a record-breaking statistic that breaks the 2020 record, which in itself was already record-breaking. So an acceleration of structural trends. What we've been seeing from investors is, and this was a big theme in 2020 and continues in 2021, is core allocation into sustainable exposures. So when rebuilding equity exposures, for example, after the drawdown in equities last year around March 2020, a lot of investors chose to rebuild these equity exposures through sustainable as opposed to non-sustainable. And that is the accelerated trend that's coming through, which we think has more room to go, will continue going. And here it's important to think of sustainable exposures and ESG not as a separate theme, but really as a core allocation to equities, which is going to continue to accelerate.
Karim, thank you very much. Thanks for joining us. Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. He will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. I look forward to speaking to him there and then. Coming up on this program, UK International Trade Secretary Liz Truss is playing down hopes of a trade deal with the United States this year. More from that exclusive conversation next. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open. 11 minutes into our trading session here in Europe, and things look actually pretty negative, down by nearly 0.5% on the FTSE 100. Losses a little more muted elsewhere. Let's have a look at some of the stocks that are on the move this morning. And let's start with the chip stocks. We've got this Apple story we've been covering today, an upgrade to the number of iPhones, essentially, that Apple wants to sell this year, and that increased guidance to some of its suppliers over in Asia, pushing those share prices higher. And we're seeing a little bit of read across from that into the European chip makers as well. So ST Micro up by 1.7% today. Let's focus in on the holiday companies, holiday providers, vacation providers. TUI is one of those. And perhaps a little bit of a surprise that TUI is cancelling some more holidays, despite a sense that things were maybe opening up, certainly for UK travellers, over the next week or so. So come the 19th of July, we are expecting new rules. That means those who've been double jabbed, those with 2 vaccines, are able to travel a little bit more freely. Despite that, we're seeing TUI cancel a number of its holidays for the remainder of July. So we'll see what they decide to do with August. Avanza, also in focus, an online stockbroker, an online wealth management business. This company missing profit estimates, and so as a result, that stock listed in Stockholm trading to the downside, down by 5.8%. So the UK International Trade Secretary Liz Truss downplayed the hopes of getting a trade deal between the US and the UK before the end of the year. She spoke with Bloomberg's Anne-Marie Hordern on the sidelines of her meeting with her US counterpart in Washington, D.C.
I have never set a deadline for any trade negotiation. because the important thing is to get the right deal that works for both countries. And I think there's a huge amount we can do together. The US is the UK's largest single country trading partner. There's 1 million Brits work in the US, 1 million US citizens work in the UK, work for UK businesses. So there are huge opportunities to build a closer relationship. That's why I'm going over to the West Coast to meet leading figures from the tech industry, meet politicians on the West Coast as well. But I'm interested in getting the right deal that suits both of our countries rather than being in a hurry to do it.
And I used to be one of those Americans in the UK working. There's loads of us. If you're looking for more of a comprehensive, the correct deal, is it fair then, though, to say that that cannot be done by 2021, by the end of this year?
Well, that would be a very rapid timeline. We've just concluded a agreement in principle with Australia, and that took a year from start to finish, and that was a very rapid timeline. So I'd agree that the kind of timeline you're talking about would be extremely fast. And what I am interested in is getting a high quality agreement, having those discussions right across the United States about how we can work more closely together. Because we do face threats from elsewhere in the world of non-market economies, of market distorting practices. And this is, I think, a strong basis for not just the UK and the US, but also other like-minded countries to work together.
I also want to move on to this potential for travel corridors. We've heard time and time again that the UK and US are working on some sort of travel corridor coming out of the pandemic. Now, I have left the UK twice when I was a UK resident to come to the United States. And because I had a blue passport, I was able to enter pretty freely. That is not the same for British individuals, even if they are vaccinated. Is there any progress with the US government on this?
Well, this is an area we are keen to see progress on. Of course, I've been talking about the level of investment of UK companies in the US and vice versa. Of course, we need to make it easier for business people to travel, because ultimately that's what helps drive trade. It's what helps drive economic growth. We know there's only a certain amount you can achieve on a Zoom meeting, and we would like to see an easier flow of our business travellers.
That was the UK's International Trade Secretary, Liz Truss, talking there about prospects of a trade deal between the US and the United Kingdom. Coming up on this programme, then, the European Commission will introduce a package of energy and climate laws today, intended to get the continent to net zero. We get more on this and the impact it will have on the energy sector next. This is Bloomberg.
Finance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We are not just going to be delivering electric vehicle charging stations. We are here to fundamentally reinvigorate the economy in a way that's going to make sense from a climate perspective, but make sense from a people perspective.
That was the White House climate advisor, Gina McCarthy, on her plans to make the US economy greener. Let's get a Bloomberg Business Flash. Top corporate stories we're following this morning. Here's Laura.
Thanks, Anna. Bloomberg's learned that Apple has asked suppliers to build as many as 90 million next-generation iPhones this year, a sharp increase from its 2020 shipments. In recent years, Apple's kept a consistent level of around 75 million units for a launch device. The upgraded forecast suggests the company anticipates its first iPhone launch since the rollout of COVID vaccines will unlock additional demand. Sticking with Apple, the tech giant is working on a new service that will let consumers pay for any Apple Pay purchase in installments over time. Goldman Sachs will be the lender for the service, which will be called Apple Pay Later. It's set to rival offerings from the likes of Affirm and PayPal. Spring Hill, the entertainment company backed by NBA star LeBron James, is talking to Nike and other potential bidders about a sale, according to Bloomberg reporting. The company could fetch as much as $750 million in a deal, but the discussions also could lead to an investment rather than a buyout. The talks come at a time when streaming services face soaring demand for programming. That's the Bloomberg's Business Flash. Anna.
Laura, thank you very much. Laura Wright here in London. Now, today the EU unveils how it plans to become the first carbon-neutral continent by the middle of the century. The bloc promises to cut 55% of its emissions by 2030, an overhaul of the transport and industry sectors, as well as a carbon border levy. They are all expected. Joining us now for a breakdown of what this means to the energy sector, what impact will this have on Europe's energy sector, is Will Mathis, our energy and climate change reporter. So, Will, as the EU then announces its new policies today, what is likely to be the impact on the energy sector in Europe?
Yeah, so the impact is going to be huge and impact every aspect of how the EU gets its energy. That one of the biggest changes is going to be renewable energy. The package is going to grow more renewables and also include new measures that will disincentivize burning fossil fuels. So whether it's in cars or homes or heavy industry like steel and cement makers, there's going to be an attempt to make it much more attractive to use low carbon energy sources all across the economy.
And we're hearing a lot, of course, and you're talking there about a big transition. That's what lies ahead, an energy transition. We'll be getting our energy from different sources in the future. So how is that going to be achieved? How are the policymakers in this Fit for 55 campaign, as it's being called, or set of policies, how are they going to make sure that that is achieved?
A few things. There's a bit of hard limits they're going to put in. So probably what consumers will notice will be, end of sales of new cars that burn petrol or diesel. They're talking about a 2035 end to selling new cars that burn fossil fuels. So that would be all EVs from that point on, other than used cars, but still, that's a huge change. And then otherwise, there is a big carbon market. There's already a carbon market, but it's mostly had an impact on power, which most people don't really notice. But it's going to be basically the carbon price is going to be taking a bigger bite out of more of the economy. So, heavy industry, and there's also adding new industries to a carbon market like heating and transportation, maritime shipping. That's all going to be having a carbon price factored into their businesses, most likely, if these proposals do in fact come into effect.
And thinking about energy companies then, Will, and how they are dealing with this, planning for this energy transition, a lot of them trying to sell off assets that maybe shareholders have taken against, or that they feel will not be as profitable as they were in a new world with carbon charges and the like. How are these policies from Europe going to make sure then that we don't just see assets pass from the public sector to the private sector, or from public realm to private ownership rather, and actually that the incentives to operate and to own those most polluting assets are removed?
Well, there's a lot happening. I mean, the most polluting assets like coal power plants, beyond this, there's also domestic policies to force those to turn off. And even in Poland, which has been previously really hesitant and reluctant to go through with these climate policies because it relies so much on cheap coal, that they're now changing and basically paying companies or getting paid to turn off coal. So, the EU sees that and is doing what it can to force and pay for this transition. So it's going to be basically the EU is going to put a bill in the hundreds of billions to make sure this happens ultimately.
Okay, to make sure that this transition happens rather than assets just passed around. Will, thank you very much. Thanks for joining us. Will Mathis, our energy and climate change reporter. Let's get a Bloomberg First Wave News update. Here's Laura Wright.
Thanks, Anna. Deadly protests that erupted in South Africa following former President Zuma's arrest show no signs of letting up. Even as the army was deployed, hundreds of stores were looted and the violence has claimed more than 70 lives. Face masks will remain compulsory on the London Underground and buses, despite the government lifting the legal requirement at a national level next week. Mayor Sadiq Khan criticised Boris Johnson's plans and said passengers will need to keep wearing face coverings unless they are medically exempt. Germany's Chancellor Angela Merkel will have a message for President Biden when they meet at the White House tomorrow. Europe wants a seat at the table too. Merkel and France's President Emmanuel Macron are pushing for the European Union to have more of a say in relations with Russia and China. At the same time, Merkel is likely to acknowledge President Biden's moves as those of a dependable ally. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, I can always count on you as a dependable ally in the newsroom.
That's good to hear. Laura Wright here in London. Coming up on this programme, we're going to talk about the liftoff for Seraphim Space on the London Stock Exchange with the backing of Richard Branson, this space startup, this space ventures firm. We're going to be talking to the chairman, Will Whitehorn. What opportunities does it bring? That's next. This is Bloomberg.
industry is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. Half an hour into our trading session here in Europe, and I can tell you that European equity markets certainly on the back foot this morning. The FTSE 100 down by 0.7%. The Stock 600 more broadly, though, losses a little more muted as we see some of the other markets in Europe being a little bit more resilient. Let's have a look at the sector breakdown then and get a sense of what's moving to the up and the downside then today. In terms of that sector push, most sectors are in negative territory, so in keeping with that overall theme, utilities, travel and leisure to the downside. We saw TUI cancelling some routes, and so that's led to some nervousness around that particular sector perhaps. Autos and parts moving higher, up by 0.7%. Banks also bouncing a little, up 0.7%. We've got to focus on inflation this morning. We had UK CPI coming out much higher than expected. That on the back of the US inflation picture, and certainly that moves the curve, moves the profitability expectations for the banking sector. Let's step away from the day-to-day markets for a moment and think about investment opportunities for the longer term. Richard Branson's successful rocket mission to the edge of space, it's been revealed the billionaire has bought a stake in the space investment firm Seraphim Space. The size of the deal hasn't been disclosed, but was part of the firm's £178 million IPO on the London Stock Exchange, which happened today. The stock trading higher on its debut. Joining us now is the Seraphim Space chair and former Virgin Galactic president, Will Whitehorn. Very good to have you with us to talk about Seraphim this morning. Trading higher by 5% or so for this Seraphim Space Investment Trust. So, Will, your reaction to the performance of that, just in the first, half an hour? Are you pleased, I suppose, with the launch this morning?
Yes, I am pleased. And it's a really important moment. There is an industrial revolution happening in space right now. There are more satellites being launched in the last 2 years than existed before the last 2 years. There is an access to space opportunity through these new systems, such as Elon Musk's SpaceX, Virgin Orbit, the other satellite launch system, which have brought down the costs of launch into space. There is a real opportunity here because space is important from the point of view of getting technology into space that can allow us to use the planet's atmosphere less. And I think we're going to see an absolute explosion in the use of technology in space, particularly in areas, data centers, solar power from space, a whole range of areas, and it's going to be really exciting.
Okay, tell me a little bit about that then. What you just said there, Will, about using the atmosphere less, because I was trying to work out what is the ESG case, and we live in an era where many investors are increasingly concerned about ESG matters on many levels. What is the ESG case for space travel, and is it different when you think about billionaires going into space for tourism, essentially? Is that different to other uses, other investment opportunities that you see in space?
absolutely different. I mean, the fact is that, what Richard Branson's flight illustrates is a new era in access to space. It's not about space tourism. It's about space access. It's about regularizing it. It's about turning it from an experimental flight every time you fly on a shuttle or a Soyuz into something that can just happen day to day. And when you get regularization, you get lower costs, you get lower environmental impact. And as a result of that, you get the opportunity to put technology up there. Using AI and robots, we can build and we can industrialize in space, and we can take the heat out of the atmosphere. For example, this very program at the moment, and downloading a Netflix film last night, uses a huge amount of energy. And that comes from data centers. That's now overtaken human transportation on the planet. All of that technology could now go into space using the much cheaper launch systems that are being developed at the moment. And as a result of that, we will be able to do things up there we've never done before. And as a result of the fact we now have artificial intelligence, we will be able to do even more up there. Quantum computing, all of these things in space are not going to damage the atmosphere.
Okay, well, that's reassuring, because when you talk about industrializing space, I think of what happened when we industrialized Earth, and I think about space junk, and I ask myself whether we'll be able to do this in a way that meets the criteria we would like it to.
Well, hopefully we'll do it with the learning from the past, because the fact is we have to do it. We have no choice. If we don't do this, with 11 billion of us on the planet by 2025, by 2055, with 11 billion people here, we are not going to be able to sustain the lifestyles we have today unless we get out there into space and use it properly. But use it properly is exactly right. You are correct. We cannot do it with junk. We cannot do it with militarization. We can only do it by doing it sensibly. And the fact is, we know how to do that now. All we need to do is actually do it. But the fact of the matter is that if we don't, we're absolutely screwed down here on the planet.
You've already invested in 19 businesses, and so your investment trust is about tapping into opportunities in space then, Will. What will you invest in next? More of the same 19, or are you looking at other opportunities? Are they in communications, data centers, where?
We are looking at some huge opportunities, and we're going to be doing it over the next 3 or 4 months. And we've actually identified quite a number of the companies we're going to use this cash that we've raised for. However, I can't tell you what they are yet because we haven't done it. But when we do, we'll be announced very quickly. But they are in these kind of areas: data, computing, basically the kind of things in space which are going to work for the future for humankind. And I predict that within 20 years of today, we will have, instead of the 5,000 or 6,000 satellites that'll be up by the end of this year, beginning of next year, we'll have 100,000 satellites in space. We'll be manufacturing up there. We'll be doing experiments for pharmaceutical companies up there. We'll be actually producing power up there within 20 years. And we'll be doing the kind of things that humans have dreamed of in the past around their planet, but have not been able to do. And in addition to that, outside of what Seraphim will be doing, people will be going to Mars in the next few years.
Okay, that sounds ambitious. I mean, the timing of this listing today of your investment trust then is obviously attracting attention. You're here talking to me about this, Will, and partly because it falls in between these space journeys, or near space journeys, from Richard Branson and Jeff Bezos. We know Richard Branson is an investor in your business. I wonder, how is that? You've worked with him for many years, but what kind of an investor is he?
Well, it's fascinating because, we absolutely, it's been coincidental that we ended up floating in between these two momentous space flights. I began working on this with Mark Boggart, who runs the fund, back last November and October. And we began thinking about when we were going to do the float back in February, March. There was a delay to the float. And actually, we've ended up, because of the delay, having very, very, very worried advisors. JP Morgan, Cazenove and Deutsche Bank, they were very worried that something would go wrong with this flight and it would damage the float. So it's absolutely serendipitous that things have ended up the way they have. I was on tenterhooks on Sunday. I was being interviewed by Bloomberg just before Richard Branson flew up there, and I was thinking about him mostly, and I was thinking about the team who were with him, and I was thinking about my friend Dave Mackay, who's a Scottish pilot, who's like myself, we're both from Scotland, from the Inverness region, and I was thinking about Dave, and I was thinking about them being safe. I wasn't thinking about the float of, Seraphim Space Investment Trust PLC, but after the flight, I was thinking about it, I have to say. I was thinking, how is it we've ended up doing this at exactly this moment? And both serendipity and somehow fate came into my mind. It is absolutely the right thing to be doing now for people to be thinking about investing in space, because this is our future. Humanity has no future if we're not up there. People like Professor Stephen Hawking said it. People like Professor James Lovelock, my old friend who invented Gaia theory, used to tell me when we started Galactic, you're doing the right thing. And I absolutely believe in what we're doing. This is not but it's a belief based upon good economics, good science, and good industrialization theory.
Will, thank you very much. Thanks for joining us. Will Whitehorn, Seraphim Space Chair and former Virgin Galactic President. Thanks very much for joining us here on the European Market Open. Coming up then on this program, shareholder activism makes a comeback. The first half of this year has seen a rebound as the economy has started recovering. We discuss what companies can do to improve ESG, how should companies engage or not with activists. We'll talk to David Roberts, Head of Activism Defense in EMEA at UBS. That conversation next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They are more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and Big Tech. Friday on Bloomberg Television and Bloomberg Quick Take.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
One thing that we can do at Engine Number One is we can do an economic and impact-oriented proxy campaign and an activist campaign like what we did with Exxon. And we launched the Vote ETF. There's a little clue in the name there, and we gave it the ticker vote. We launched this ETF because it's a way for people to stay invested in these big public companies over time. And then we, as the manager, will vote very actively.
That was the CEO of the activist firm Engine Number One, Jennifer Grancio, at the Bloomberg Sustainable Business Summit discussing the firm's new ETF. Grancio says it gives long-term investors that want to hold companies, hold them accountable. It gives them the opportunity to use their voting power to create change rather than having to sell the shares, I suppose. It comes after Engine Number One's successful ExxonMobil campaign, where they managed to gain 3 board seats. And sticking with this topic, shareholder activism has seen a resurgence in the first half of this year as the economy began recovering. A total of 116 activist campaigns were launched in the first 6 months, aimed at companies worth more than $1 billion. That's up from 87 over the same period in 2020 and 115 in 2019. And this momentum is expected to continue into the second half of the year and beyond. Joining us then with analysis is David Roberts, UBS Head of Activism for EMEA. David, good to speak to you. So there's a lot going on here. How would you describe the nature of activism that we're seeing in Europe in 2021?
Well, good morning, Anna. Thank you for having me on this morning. Well, I think what we're seeing is a resurgence, not just in number, but also in the profile of some of those campaigns. We had a bit of an armistice during the COVID period when I think a number of investors recognized that it would not be the right moment to be putting companies under pressure when they were managing all sorts of other very significant stakeholder issues. And so as we're exiting, hopefully, the COVID period, then I think there is more confidence that it's the right time to challenge companies in terms of how the business is performing and indeed how well they're positioned for the future. And so it's not just a number, it's the profile of those campaigns that's really striking in the first half.
We talked, David, that we just heard from Engine Number One, famously, of course, a green campaign run against Exxon in the United States. That took a lot of headlines, but is that typical? Is that the kind of activism we're seeing? Is it ESG driven, or is that just a minority?
I think it's important to distinguish between different types of ESG driven activism. I think on the one hand, the ESG-driven activism that you're seeing around some of these campaigns is really very similar to the sort of portfolio change that activists have pursued for some time. It's just a different driver. So in this instance, we have situations where activist is suggesting that a company is badly positioned for the future for that energy transition, and that is directly impacting the returns the shareholders are receiving. In that respect, it's not wildly different from another activist campaign where you push for a portfolio change, perhaps push for board representation to stimulate that change, or with an intention to really try to improve returns for shareholders. There's other campaigns out there which are, I think, much more directly driven around trying to ask companies to accelerate on their environmental, particularly environmental ambitions. Those are led by other stakeholder groups, etc., and really asking people to go harder and faster in order to deliver very specific environmental outcomes. There's some quite different themes, but what is absolutely for certain is that given the interest from other shareholders that are absolutely at the core of any activist campaign and the interest that they have in ESG matters, ESG themes within activism is definitely here to stay.
So that theme is here to stay. When companies seek your advice then, David, what are they looking for advice on? Are they looking for advice in, okay, how do we engage with this activist? Or are they asking, how do we fend off this activist? Or what should we say to other shareholders? What do we say to other stakeholders? What does the conversation typically look like?
It's a great question. I think it really depends sometimes on the nature of the company. But certainly our advice is not to get into defense mode. In fact, the activist defense, I think, is a label that is really unhelpful for the conversation with a lot of companies. Because I think if you're drawn into a defense, which is a natural human, quite personal instinct when you've been very directly criticized, then actually that can pour fuel on the fire, because being defensive is certainly not something that other shareholders want to see. So our advice is very much around how you are actively engaging the other shareholders, because what is often forgotten in an activist campaign is it really is about the hearts and minds of those other shareholders and whether or not they are supportive of you as a board, as a company, or with the demands of the activist. And in that respect, it is all about deeply listening to those shareholders, really understanding what they think about the company, and then making sure that in any response, you choose your battlegrounds very carefully, and you make sure that whatever you're doing is something that's going to positively influence the hearts and minds of those other shareholders.
That's interesting. So trying to assess whether the activist represents the views of other stakeholders in the business or doesn't, and that would be a good place to start then, I guess. Is there a playbook here that is dictated by geography, or is that too simplistic? Is it actually more about sector or more about the culture of a business? I mean, is there a sort of US defense playbook, a European defense playbook? How does that conversation go, David?
Well, I think there's a real subtlety emerging in Europe, certainly in the way that the activists are approaching companies now. So I think where it might have been a little bit more sledgehammer early in the piece, I think there is now an understanding that there are not just regulatory, but also cultural differences, both in the boardroom and amongst other shareholders, that an activist really has to understand if they're going to be able to build support from the other shareholders that they're trying to seek engagement with. So I think there's a subtlety to that now. They're engaging earlier. We're certainly finding that they're engaging with shareholders earlier, that they are adjusting potentially the way in which they then come out publicly and refining their approach to reflect what they're getting back from investors. So I think they're being more nuanced. I think companies have to be more nuanced as well in response. And certainly, if there is a playbook that was a bit of a firefight of press releases, that's certainly not the way that we're advising companies to engage. And in fact, the shareholder conversation, the direct shareholder conversation, is where the company should be at its strongest.
Okay, and just to finish off, David, maybe where I should have started, how do you define activism these days? We speak to so many shareholders who say they want to use their shareholding to drive change. Are we all activists now?
I think we are, and in fact, my personal view is that we should be, encouraging other investors certainly to be actively engaging with their companies and being very open and honest about how they feel about it. I think we tend to define activism as when this becomes into a very public situation, because that changes the temperature and everything for a company, and indeed can be really quite disruptive. So I think active engagement is something that all companies, in fact, all advisors should be supportive of, but it's the public campaign that can be really very distracting and divisive, potentially, for businesses, that I think we're all seeking to avoid.
Okay, really interesting conversation. Thanks so much, David, for joining us. David Roberts, UBS, Head of Activism here in EMEA. Coming up on this program, we'll be back to the market action. We'll look at US CPI data and what this means for Jay Powell's upcoming testimony before Congress. Fed Chair Jay Powell will be there, of course, today. We'll discuss that with Laura Cooper. She'll be with us from the Markets Live team next. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European market. Open 53 minutes into our trading session. European equity markets trading to the downside. One standout mover to the downside in Scandinavia, down by 10%, as you see, is Avanza, falling as much as 10% after the company reported second quarter earnings. So we'll keep across that story. But broadly speaking, we are seeing losses across European equity markets. Laura Cooper, Bloomberg's Markets Live macro strategist, is with us. Good morning, Laura. Is this all still US CPI hangover? What's driving this negativity? Of course, we added UK CPI to the mix this morning.
Well, I think it's a confluence of factors. Yes, I do think markets are still digesting that exceptional US CPI print. We're also still having those recovery narratives emerge across Europe. And then, of course, we have earnings season kicking off soon. So really, it's those number of factors that are keeping really equities relatively range-bound, waiting for the next catalyst.
Yeah, waiting for the next catalyst. Could the next catalyst come from Powell's testimony? We're going to hear from him a couple of times, I think, this week. What will we be watching for?
Well, I think markets will be watching for any hints of how he is perceiving that inflation print. So when we saw yesterday, just that core month-on-month gauge came in at 0.9%, clearly well above consensus estimates. And yes, while a bulk of that can be attributed to reopening factors, to those temporary supply bottlenecks, we are seeing signs that price pressures could prove persistent. So if we look, for example, at the Atlanta Fed's sticky CPI gauge, that's been hovering above 4% for a number of months. We are seeing signs from small businesses that they continue to see price pressures. So I do think he will be pressed on whether we are seeing that tail risk of sustained inflation widen and really what the central bank's reaction function could be around that.
Yeah, I was drawn to some comments by our colleague John Authers talking about the core of core measure of CPI and suggesting if that doesn't start to fall soon, then that will really raise questions about how long-lasting, how entrenched this inflation push will become. Sticking with inflation then, UK inflation out this morning, Laura. What did you take away from that? The pound up by 0.2%. I mean, these numbers, they were above what was estimated, above where economists had flagged that they would be. It is part of a global story, but UK inflation has been higher recently than perhaps other parts of the world.
Yeah, and that has been the case. I mean, if we look at that month-on-month print, it came out at 0.5%, well above expectations for 0.2%. Again, there is this question of, economist estimates, how really reliable are they amid this pandemic data right now? But I think really the key takeaway is we are seeing signs of potentially longer lasting and higher inflation than most central bankers expect. So could this actually prompt them to quicken the pace of tightening? That's something that could be repriced into markets. And we have the Bank of Canada later today. We had the RBNZ overnight really warning that they're going to be potentially lifting rates by year end. And I think that's going to be a key dominant theme emerging across markets coming forward in the next few months.
Laura, thanks so much. Laura Cooper, Bloomberg Markets Live macro strategist. Thank you very much for joining us this Wednesday morning. The Wednesday session looks negative for European equity markets. That is it for the European Market Open Surveillance. Early edition is next. This is Bloomberg.
Lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Inflation is front and center in everyone's mind, whether you're a bond investor or an equity investor.
Countries like China don't differentiate between civilian and military in the same way.
The US is the UK's largest single country trading partner. I have never set a deadline for any trade negotiation.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 14th of July. I'm Francine Lacqua here in London. To all of our French viewers, also happy Bastille Day. Here's what's coming up on today's program. U.S. inflation surges by the most in 13 years. The Fed Chair Jay Powell faces a two-day grilling in front of Congress. JP Morgan and Goldman's slide after suffering worse than expected slumps in fixed income trading. Today, Bank of America, Citi, Wells Fargo also report. And SPACs, commodities, and the Super League. We're joined later in the program by VAM Investment Chairman Francesco Trapani and AC Milan President Paolo Scaroni. So first thing is first, let's get straight to our top story. And of course, it's the markets and inflation. U.S. headline inflation prices accelerated to 5.4% year on year in June. That's the most since 2008. Now, here's what some of our guests and banking heavyweights had to say about that figure.
We see some of the reopening, restart, inflationary pressures coming through.
What today's CPI number tells us is that the market's going to switch to worrying about inflation again.
Inflation is front and center in everyone's mind, whether you're a bond investor or an equity investor.
The bond markets are sending a very clear message. This is not a big deal. It's transitory.
And yet the increases are going faster for longer.
I'm not going to assume it's going to be transitory.
A large part of that will have to get passed on to consumers.
Investors should certainly prepare for the possibility that bond markets are wrong.
Inflation could be worse than people think. It's going to be with us through the better part of next year.
I don't think it's all going to be temporary.
This is not going to be music to the Fed's ears.
That doesn't matter if we have very strong growth.
Well, today, Jay Powell begins 2 days of testimony in front of Congress, and the June CPI print may make his job convincing lawmakers that upwards pressure are transitory significantly harder. Well, let's get straight to our next guest. He's Koku Agbo-Blua. He's Global Head of Economics, Cross-Asset and Quant Research at Societe Generale. Koku, thank you so much for joining us on a day like today where it's actually unclear what exactly we're looking at. We have a wonderful piece by our John authors basically going through 35 targets to try and figure out whether we're measuring it correctly, whether we're looking at the right thing. And his assumption is that actually we should be looking through this bout of inflation. Would you agree?
Yes, absolutely. So we put out a piece in our global economic outlook called Inflation Transitory Until Proven Permanent, because there's a whole host of arguments, and I've seen the arguments that you portrayed so far. But our take is that you have a base effect. So last year we had, the oil price future closing in negative territory. So if you're comparing the basket of goods and services today versus last year, it's not a surprise for the base effect to be showing higher inflation, even if it's higher than expected. The point, though, is that you have the concept of demand satiety and supply response to high prices that would normalize things over time. And let's not forget that the Fed was fed up with inflation, pun intended, at their last FOMC meeting when they signaled a faster than expected rise in interest rate as of 2023, which would suggest tapering as of this year. So the Fed is not has already reacted, which has tapered five-year break-even inflation expectation, and that's why the bond market is not going collapsing at this stage.
Yeah, the bond market certainly doesn't seem to be as worried as they were 3 weeks ago. We also heard from, the New Zealand Central Bank, and actually a lot of the focus there, including the Bank of Canada, that could turn more hawkish. Are we underestimating, the hawkishness of certain central banks' moves that could actually push at least central banks in the region to act faster?
Absolutely. So this is clearly the pressure in respect to each economies. I mean, the UK is also seeing bouts of inflation, or at least figures that are higher than expected. You mentioned other countries that will have to face some of these pressures in emerging markets, for example. And I think that this has to be based on data and facts. But ultimately, when it comes to the US and Europe, we're still not at peak jobs. So the output gap is pretty, I think, significant, even though there are supply labor shortages in some areas. But ultimately, when it comes to these two major economies, which influence the global nature of inflation, we don't see the reaction being sooner than expected.
Goku, what are you uneasy about right now? So there are concerns about China. There's concerns of where China growth is headed, also the crackdown on certain technology companies. Is China your biggest worry, or is it something else?
Well, the biggest worry and let's say the known unknown is what I call the double elephants in the room. Because if you go into 2022, what you realize is that there's tapering by the Fed, and there's question about whether we raise rates sooner. Let's say end of 2022 or early 2023. But at the same time, we're going to be feeling a tapering of fiscal policy as well, because budget deficits are going to shrink and reduce. And same thing when it comes to some of the European countries to start repairing the sovereign balance sheet. So facing double slowdown or double tapering, fiscal and monetary, could be a bigger drag on the economic activity than we suspect. So this is, I think, what the bond market is pricing, and this is why they are not looking to react too aggressively because of that backdrop of fiscal stimulus slowing down.
Goku, also today, the European Union is set to unveil this landmark deal on how to phase fossil fuels. How much does that translate into the real economy? Could there be, if not a shock, some kind of transitionary hiatus at some point?
Well, this is a very important point, and this is the next generation in EU or the European Green Deal around the energy transition. For us, this is potentially a green revolution. You can think of it as the Marshall Plan or the industrial revolution at the beginning of the century, because it will give industries, autos, oil and gas, opportunity to invest into sustainable growth. So these restrictions, I think, are triggering a force for good, so to speak, and obviously some disruptions. But ultimately, we believe that these fiscal stimulus with the green tilt ultimately have the potential for generating a sustainable growth.
Koku, thank you so much. Koku Agbo-Blua, they're Global Head of Economics, Cross-Asset and Quant Research at Société Générale. Now, I mentioned it's Bastille Day, so happy Bastille Day to all of the French watching us and listening to us also on radio. We're also looking at live pictures of Emmanuel Macron. Today is what we call in France the défilé of the 14th of July, which is a huge military parade. Remember a couple of years ago, President Trump actually was very impressed by it and then went back home and actually asked for the same thing. We'll see also the Patrouille de France later on with the flying tricolor over Paris. We'll have plenty more on that. Smart Conversations continue on Bloomberg Surveillance Early Edition. We have a lot coming on because later in the program we speak to the VAM Investments Chairman. He's Francesco Trapani about their SPAC launch in Amsterdam. It's all about consumer. And then after that we speak to the AC Milan Chair and former Eni Chief Executive Paolo Scaroni. Up next we discuss U.S. bank earnings. If you have any questions for any of our guests or for us, just IB plus TV Go. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's talk about the banks, and investors are closely watching the latest U.S. big bank earnings for clues on how the pandemic recovery is playing out. JP Morgan, Goldman Sachs gave mixed signals yesterday. Today it's Wells Fargo, Bank of America, and then Citigroup's turn. Well, let's get straight to our Bloomberg finance reporter. She's Nabila Ahmed. And Nabila, I am so excited to actually have you on the program. Let's start with the positives. Investment banking performance was great for both JP Morgan and Goldman Sachs. What were the numbers like?
Francine, this was a quarter where the investment bankers definitely had to step up to offset some of the losses from those trading businesses. And they absolutely delivered. At Goldman Sachs, we saw a 36% jump in the investment banking revenue to $3.6 billion. Remember, Goldman actually advised on each of the top 5 deals of this year. That includes that mega merger between Discovery and Time Warner. That was $43 billion. JP Morgan also advised on that deal, and they had a record quarter for their investment bank, rising 25% to $3.57 billion. And this all comes as global deal-making is enjoying an absolute banner year. We've already had $2.5 trillion of volume in the first half, Francine.
Nabila, investors ended up selling because I guess they're focusing on the things they're worried about.
That's exactly right. Look, this was always going to be a tough quarter because of all of those stellar performances we saw from trading this time last year in the middle of the pandemic and the volatility that induced. So it was always going to be hard. But what investors are really focusing on is what is happening in the future. Will deal activity hold up, for example? And will that come at a cost? Will banks have to actually pay up to retain and attract top talent, top deal makers? And Jamie Dimon certainly didn't assuage any fears there today, saying that, if they can hire good bankers, they're going to spend the money. And he said, we don't manage the company so that we can tell analysts what the expense number is going to be. So costs are definitely an issue. There's also a question mark over loan growth and when consumers will be ready to spend again.
So what does it tell us about how the recovery is going and the reopening?
Well, Dimon said that he thinks that consumers are ready to go and that they're going to be ready to spend pretty soon. And that is a really good sign. And certainly from market-related activity, consumer spending levels, credit quality, there was some really good signs. But the question is, when do consumers step it up a bit? We saw loan growth for consumers actually down this quarter, and both Goldman and JP Morgan, interestingly, also warned about this new Delta variant of the virus, Francine, and what that might do to the recovery and also to deal making going forward.
Nabila, thank you so much. Bloomberg finance reporter there, Nabila Ahmed, joining us this morning. Now, coming up, we'll have plenty more, of course, on the banks. Smart Conversations continue on Bloomberg Surveillance Early Edition. Later on in the program, we also speak to the AC Milan chair and former Eni chief executive, Paolo Scaroni. Up next, though, we speak to the Bluebell Capital chairman, Francesco Trapani, about their SPAC launch in Amsterdam. Coming up, more on all of that. We look at markets, we look at bonds, we look across assets. This is Bloomberg.
Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, our next guest is Francesco Trapani. For many years, he was chief executive of the Italian luxury company Bulgari. Currently, he is the chair of activist investor Bluebell Capital and the executive chairman of VAM Investments Group. He joins us today to discuss the launch of VAM's SPAC in Amsterdam. Mr. Francesco Trapani, thank you so much for joining us. When you look at exactly what you're working on and focusing on, it's very clear that it's consumer. So where do you see the most value? Does the way that the pandemic actually affected me and you and everyone else mean that we will shop differently? And is that where you see opportunities and value?
Well, as a matter of fact, we are looking at the consumer segment on a, I would say, European level, because our SPAC will be European. So basically, you know, at this stage, I think we have a competitive advantage with the IPOs, because while when you do an IPOs, you have to, you know, clarify what you have done in the recent past. This is not the case when you do a SPAC, because there is a different relationship. You have one single shareholder that is able to dedicate enough time to understand your past and your future expectations. So it's a better proposal for properly evaluating your company.
Where do you see, Mr. Trapani, the way that we consume? How does that change? Does it change more for luxury because we buy online? Does it change more for the way we pay for things? Where would the biggest shift actually come from post-pandemic?
Yeah, we have seen a strong acceleration in luxury. This is the case because there are two regions, Asia on one side and US on the other side, that are performing extremely well. This is influenced also by digital, to be honest, because of course the fact that we cannot, you know, go in stores, touch people, and etc., is accelerating the business done with digital. So these are the two areas that are actually showing very positive results in the past weeks or a few months, actually.
Is it, I mean, what do you worry about the most for your SPAC? Are there, you know, if you look at the consolidation phase and actually some of the bigger groups also interested in some of the smaller groups, or M&A that seems to be picking up and back on track, is it going to be difficult for you to find your targets?
No, we have, you know, we have two different things. On one side, we have an organization of private equity, so we have people on the field that actually are looking around and see which are the different opportunities. On the other side, we have a short list of companies that we know extremely well and that we are looking closely. And when you talk about this short list of companies, you find a bit of everything. So you find, for example, in a particular sector, two champions of a specific business that are in two different areas. So combining the two, you would have a champion in Europe by far, actually. You have in another segment, you have the world leader in beauty, big company with 110 million EBITDA and production in 3 different continents, and so on. So you have the different opportunities in different segments.
So, Francesco, where do you see the biggest? Where do you see the biggest proposition? Is it also because of a region, because people consume differently in China than it is in Europe? Like, if you look at the criteria of some of the targets that you'd like to focus on, what's your number 1 and 2 criteria? Region and space, or is it more of what they're actually, you know, selling?
I would say, Francine, that it depends. We have certainly the region, in the sense that there are companies that we look at that are very exposed to the Asia on one side and to the US on the other side. And we have also, companies that are maybe in the wrong area today, that is Europe, but they do a specific business that is actually doing extremely well even in Europe. So we are looking into the two different propositions.
And what part of the segment exactly would you be focusing on? Luxury first or luxury second? Is there like a technology enabler that would be on your radar?
We actually have several targets under our radar. And, some of them, as I said before, are very focused on a specific industry. Others are more focused on geography. So we are going to be opportunistic. As you may know, this is a business where you have to be opportunistic, because at the end of the day, what you have is a pot of capital that has an expiration date that is in 2 years' time. And if you're not able to do a combination by the end of the 2 years, you lose your you lose your at-risk capital. So while we are working on different targets that are, combined differently, we will be opportunistic, and we will do the first one that comes.
So why Amsterdam for the SPAC? First of all, why exactly did you choose for a SPAC, and why Amsterdam?
We started thinking about a SPAC a few months ago, when actually the place to list the SPAC was the US. So we started with this idea, but then when we went into some discussions, we realized that our territory is going to be Europe. And in Europe, you have plenty of companies that are possibly able to be listed in Amsterdam, and won't be actually able or, let's say, willing to be listed in the US, because it's a market that is far away, because very often they do very little business there, and so on and so forth. So we decided then to switch to Europe. And when you switch to Europe, the only real place today is possibly Amsterdam, because it's the place that actually, has a plethora of investors that actually international. So you have plenty of US and UK investors that are, willing to invest in Amsterdam, as well as a number of local, quote unquote, investors that are Italian or French that actually are, ready to invest in Amsterdam. This is why we have decided then at the end to list the company in Amsterdam. At the end of the day, we are actually talking about a company that will work in Europe. So it's we can actually list the company in Amsterdam. Thank you.
Francesco Trapani, their executive chairman at VAM Investments Group. Now, in the meantime, we look, of course, at the markets. Some more smart conversation continuing on Bloomberg Surveillance Early Edition. Up next, we also speak to the AC Milan chair and, of course, to the markets. So futures mixed post CPI data. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
U.S. inflation surges by the most in 13 years. Fed Chair Jay Powell faces a two-day grilling in front of Congress. JP Morgan and Goldman slide after suffering worse than expected slumps in fixed income trading. Today, Bank of America, Citi, and Wells Fargo report. And inflation, commodities, and the Super League. We're joined by the AC Milan chair and former ENI chief executive, Paolo Scaroni. Well, good morning, everyone. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance, the early edition. Now, we have quite a lot going on this Wednesday, July the 14th. First of all, happy Bastille Day to everyone watching us from France. Second of all, the markets are definitely on the move, so we'll get onto those in a second. Futures mixed after the post-CPI data out of the U.S. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sydney has extended its lockdown for a further 2 weeks as Australia's most populous city battles a COVID outbreak. The city recorded 97 new cases yesterday. The slow vaccine rollout has made the country particularly vulnerable to the Delta variant. Now, deadly protests that erupted in South Africa following former President Jacob Zuma's arrest show no signs of letting up. Even as the army was deployed, hundreds of stores have been looted in KwaZulu-Natal and Gauteng provinces. The violence has claimed more than 70 lives. Here in the capital, face masks will remain compulsory on the London Underground and buses, despite the government lifting the legal requirement at a national level next week. Mayor Sadiq Khan criticised Boris Johnson's plans and said passengers will need to keep wearing face coverings unless they are medically exempt. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, our next guest is Paolo Scaroni. He's the current chairman at AC Milan football team. Before then, he was chief executive of one of the oil super majors, ENI, for almost 10 years. Before ENI, he was the chief executive of Italy's biggest utility. And also, let's get straight to Paolo Scaroni for insight on oil, on OPEC, and of course, on football. Paolo Scaroni, thank you so much for joining us. When you look at what we saw in OPEC over the last 10 days, it was division, possibly actually the alliance also breaking apart. What does it mean for the price of oil for the next 6 and 12 months?
Well, if this division doesn't compose and if OPEC Plus doesn't increase production, prices of oil can only go up because consumption is going up as a consequence of the opening following the vaccination, the mass vaccination, particularly in developed economies. So consumption will continue to go up through the next semester. And if production doesn't follow, prices have to go up, also because inventories are relatively down. Everyone expects that there might be a composition between the UAE and Saudi Arabia, in fact. But for the time being, there is no sign that this composition will happen anytime soon.
Paolo, what worries you the most about the world economy and the European economy? So is it inflationary pressures that could also be coming through commodities, or is it just how we're handling the virus?
No, I have to tell you that I'm not particularly worried at all. I think that the European economy will improve, and it is continuing to improve month after month. The Italian economy as well. So for the time being, I believe, apart from hypothesis of having oil prices really skyrocketing, which I don't think will happen, I see only positive news in front of us. Inflation, yes, is picking up, but it's, in my view, a temporary phenomenon. And therefore, I think we have good news ahead of us.
Is there anything that actually could make you less confident about the future? If inflation, I don't know what you do with inflation, but could there be some kind of market shock because of inflation taking a stronger hold than we're expecting, and so monetary policy doing something different? When you go around the world, or actually now probably on Zoom, speaking to chief executives, do they point to this as a concern?
Well, everyone thinks that at least for the next couple of years, interest rates will continue to be extremely low as they are today. Yes, there are some inflation, particularly in raw materials, but even this inflation in raw materials is kind of leveling off right now. And apart from, in economy, you can always have something new that you are not expecting. But if this does not happen, I see really blue skies in front of us for the next 18 months. Then what will happen later? How the central banks all over the world will start restricting the immense liquidity that we have in all the economies of the world, that's another story. But for the time being, I'm not worried.
Paolo Scoroni, when you look at the hopeful Italy when it comes to investors and things like that, are you confident that the plan put in place to use the EU money will go in the right places? So for digital transition and for a green transition?
No, first of all, let me tell you that every morning I wake up and I think how fantastic it is to have Mario Draghi as Italian Prime Minister, because he gave to Italy a level of credibility we didn't have for a long time. And this is true for, the recovery plan, is true for the investors, it's true for the Italians as well, who are more willing to invest and to believe in the Italian economy than before. So I have to tell you, I'm quite positive on Italy, also because we have Mario Draghi as Prime Minister.
Paolo Scoroni, let's also talk, of course, about football, which is, with your other hat. We saw, first of all, congratulations to Italy, of course, on the win of the Euro 2020. And then it was really plagued by really awful and horrible incidents of racism, especially against the 3 football players here in England that missed the penalties. What does football need to do to eradicate racism?
Listen, I believe that what happened in England has been action of few idiots that you have everywhere in the world. So it's not to say that we have to tolerate that. We have not at all to tolerate this kind of things. But I don't think that English people are racist at all. I think they have demonstrated for years that they are open, that they are certainly not racist. If few idiots do these kind of things, we have to be very, very much against it, but let's not generalize the phenomena. As AC Milan in particular, we have been developing a special project to defeat racism in Italy as well, because even in Italy we had some similar phenomena, and we really believe that everyone has to take action against it. I've seen what happened in England, the Football Association, the politicians, even the royals have been extremely clear on that, and we have to continue in that direction.
So what kind of policies would you put in place? Is it AC Milan putting, actually banning people from going to matches, or is it putting pressure on technology companies, on social media companies, so that these, awful things don't get posted online?
Well, on this, we have to use the technology to identify people that in the stadium have a racist behavior. Lately, as you know, Italian stadia has been closed, so the phenomena didn't exist. But as soon as we will start again to open the stadia, we have to use technology to identify people, because this is the only way in which we can really act on racism in stadia.
Paolo Scaroni, on the Super League, do you accept now that it was a mistake? Do you have any regrets about it?
Well, a mistake. Let's say the problems that have originated the idea of the Super League are still with us. Most of the European top clubs are losing money, and this we cannot continue to lose money and to continue to invest in players and to be at the top in this fantastic sport which is football. Now, the project of the Super League as it has been formulated is dead. On this, no doubt about it, but we have still the problem to solve. And so we have to invent, to identify, possibly together with UEFA, a solution to the problem that we are living. Otherwise, there will be another idea which will be originated outside of UEFA, and this is certainly not positive.
How would you do it? What kind of idea? What's the solution here for you, Paolo?
Well, there are several potential solutions. Some of them we can imitate what has been happening in the US for the NBA, for example. But at the end of the day, we cannot continue to lose money. And today we are losing even more money for COVID, because the fact of having the stadium closed has been, for all of us, something extremely negative, even on the economic front. I see that in most of European countries, and I hope this will happen in Italy as well, we are reopening the stadium. To see Wembley full of people has been extremely encouraging to me, but that's not enough. We need to find other ways to restore the economics of the European clubs.
Paolo Scaroni, thank you so much for joining us today. He's the chairman of AC Milan and, of course, deputy chair also at Rothschild. Now, in the meantime, this is what the markets are doing. This is a picture for futures, a little bit mixed ahead of that Jay Powell testimony and post-CPI data in the U.S. So I look at treasuries. We also look at the big U.S. inflation debate, really stirring the debate on how long the Federal Reserve will maintain ultra-loose policy. The 10-year U.S. Treasury yield retreating to about 1.4%. Dollar also trimming some of the gains after yesterday's surge. We'll have plenty more on that. We'll also look at bank earnings. Coming up, the European Commission will table a package of energy and climate laws today, intending to get the continent to net zero. We get more on this and the impact it will have on Europe's auto sector next. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance Early Edition. Weekday mornings on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we look at the markets. We, of course, look at politics, and there's quite a lot going on today. The EU unveils how it plans to become the first carbon-neutral continent by the middle of the century. Now, the bloc promises to cut 55% of its emissions by 2030. An overhaul of the transport and industry sectors, as well as carbon border levy, are expected. So for more on this, let's get straight to our Brussels correspondent, Maria Tadeo, who joins us from the capital. Maria, what exactly is the EU saying when it calls Fit for 55? What does it actually entail?
Yeah, Francina, you know, a lot of people do like to joke that it sounds like a diet, but in fact, it's a huge plan to cut down emissions by 55% when it comes to 2030. And Francine, today we're looking at a monster package. It is huge. This proposal from the Commission could change more than 13 European legislations, again, trying to cut down emissions. But not just that, this is going to affect pretty much the entire green spectrum in Europe. You're looking at pricing, you're looking at energy efficiency, you're looking at emissions being cut too, but also the ripple effect that this has on the industries that it touches, from aviation to transport. The one thing to keep in mind, Francine, about today's announcements, of course, is that this is a proposal from the executive. It's the Commission, but again, the politics will have to sign this off. And we are expecting a negotiation between the European Parliament, but in particular, the heads of states and the European governments. Normally, this can take up until 2 years, but of course, in this case, time really is of the essence. 2030, that's the goal, and it really is around the corner. So whether it happens faster than usual remains to be seen, but that is definitely the intention.
Carbon tax, Maria, and pricing are also taking center stage. Is polluting going to become more expensive?
Yes, and Francine, that's the question that, of course, for the business community is key. And the European Union will tell you it will become more expensive. It won't be incentivized. And this is the reality of the future industries. Now, in terms of today, there will be two pillars precisely looking at pricing. One is changes that we're expecting will be made to the European emissions trading system. This is where companies buy and sell credits to be able to pollute. The criteria around that is expected to change and more sectors be included. And then, of course, as you mentioned, the carbon taxes has been in the making for weeks. Again, the idea is that you do not shift your pollution somewhere else. You get taxed if you do import from heavily polluting industries into Europe. That is also expected to be announced today in this huge, huge monster package from the European Commission.
Maria, thank you so much. Maria Tadeo there in Brussels for us with this pretty exciting announcement from the EU. Now let's get more on the impact of Europe's auto sector with Craig Trudell. He's our autos and industrials team leader. Good morning, Craig. Thank you for joining us. So what moves are we actually expecting from the EU on autos over the next few years?
So the two big headlines are for 2030 and 2035. With 2030, it's a bit of a moving target at the moment, with the expectation that the target for emissions reduction from cars to be somewhere in the range of 55%, potentially as high as 65%. The other big element of this that is really going to be interesting to watch is for 2035, the target becoming 100%. So effectively, combustion engines are phased out by that point. So we've heard California set that date, but and we've heard some select countries start to talk about phasing out the combustion engine and sort of setting a date for that. But this would be really unprecedented in terms of the scale of impact that would have.
Today's proposals kick off years of political wrangling with member states over, of course, how to do this and how to implement this. Where will this end up?
Yeah, so we've already reported on the idea that France in particular is concerned about the idea that plug-in hybrids would be phased out as early as 2035. A lot of the car makers want to see sort of a longer leash for those going forward. they are investing heavily in EVs, but even companies like Volkswagen, which, is investing more in EVs than anybody else. Herbert Diess was on Bloomberg television yesterday talking about just the level of difficulty that will be involved with just scaling up the battery production to support this many EVs this quickly. It's really a matter of taking, more than a century of combustion engine production capacity and sort of, doing away with that and completely switching to batteries. That's going to be a really sort of Herculean effort for the industry over the next, decade plus.
Craig, thank you so much. Craig Trudell, there, our autos and industrials team leader. Now, coming up, we'll have plenty more, of course, on the transition to green, also electric ambitions, as we've just discussed. We hear next from Europe's biggest car maker about its plans to expand in the U.S. and go head-to-head with Tesla. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, a lot going on, of course, in the markets, a lot going on with the EU and the green transition. Volkswagen is also stepping up its electric ambitions. It will decide this quarter on building more electric models in the U.S., betting that the Biden administration support for battery-powered vehicles will actually help the German car maker return to the position it held in the market half a century ago. With the VW chief executive, Herbert Diess spoke with Bloomberg's Guy Johnson and Alex Steele.
U.S. is becoming an electrified country. The Biden administration heavily bets on electrification. We have been investing into fast charging. We already are in the investment phase of a plant which is going to be converted to electric car production. In the background, you see the ID4, which was very nicely received in the United States, and we will come with many new products. The ID Bus, famous product, iconic product, loved product in the United States, is coming back to the US, many more products. So I think we have to use that opportunity, and we will do the utmost to make sure that we get back to the position we wanted to be as a volume manufacturer.
You've only confirmed, though, local production of the ID4 SUV in the US. And I wonder, are there going to be other models, as you talk about a lot more models, that are going to be made locally? And can you give me a time frame for that?
We are currently reworking our US strategy, and our team, Scott Keogh's team, is working on that. We had a chat this morning. There are many ideas which we have to prioritize, but be sure we will come with more markets from local production in the United States, and we're going to know which models these are going to be, I would say, latest in the third quarter.
Dr. Diess, who are you going to take market share away from in the United States?
I think, it's now everyone is starting with a white sheet of paper, and the electric market will be reparted differently than the ICE market. So we start from scratch, and it will depend on we have new competitors, Tesla being probably the most serious and the most successful, and it will depend a lot on the electrification strategy of the other market participants. We feel strong. We are early. We have a strong platform. We have a wide range of cars. We are coming with electric cars from the premium segment, Porsche, Audi, and then in a broad range of Volkswagens. We should be in all segments. We should become relevant.
Well, that was the Volkswagen Chief Executive, Herbert Diess, speaking to Guy Johnson and Alex Steele, and of course his green ambitions. Now, coming up, we'll have a full roundup of what we're seeing in treasuries. Again, the inflation debate, once again, at the forefront as Jay Powell testifies in Congress, but actually bonds are not moving that much. Same for treasuries. I would urge everyone to go and see and read an opinion piece by our John Authors. Fantastic, looking at 35 of the indices that he's looking at to make sure that there's not going to be surprise inflation. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller is actually out this week, so I'll be joined by Kaylee Lyons and Danny Berger. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They are more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and Big Tech. Friday on Bloomberg Television and Bloomberg Quick Take.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Inflation is front and center in everyone's mind, whether you're a bond investor or an equity investor.
The bond markets are sending a very clear message. This is not a big deal, it's transitory, and not only is it transitory, but policymakers will not have to budge in response to the inflation.
We're just blowing away a forecast that was already revised up by a percentage point at the last FOMC meeting. So when does the Fed recognize that?
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, July 14th. Our top stories today: high price problem. Fed Chair Jerome Powell will try to convince Congress that inflationary pressures are not a long-term concern. Powell begins 2 days of testimony today. And bumper day for U.S. banks. We'll get second quarter earnings reports from Bank of America, Citigroup, and Wells Fargo. And finally, Apple's expecting a run on iPhones. It plans to build as many as 90 million this year. That's a 20% increase. I'm Danny Berger alongside Francine Lacqua in London, Kaylee Lines over in New York with Matt Miller off all this week. And it is a day after a hot CPI reading, but we are no closer to solving the debate. Is inflation transitory or not? Francine, I'm so sorry if you are sick of hearing that T word. I hate to break it to you. It's not going anywhere anytime soon.
Yeah, I'm not. Actually, I love it because I found a Bloomberg opinion piece written by our John Authors who explains it beautifully, the 35 indices that he's looking at to try and figure out exactly whether we have sticky inflation or not. So I'm all for trying to figure out the inflation debate. And of course, the markets are also trying to figure this out because of that hot number. The other stories, of course, Kathy Wood, maybe with a bit of a warning on Chinese stocks. Kaylee, how is this all playing out in the markets?
Well, it's interesting. Investors maybe seem to be following Kathy Wood's lead there because Chinese equities were the big underperformer in Asia overnight. Granted, pretty much every major benchmark in Asia was lower, including the Nikkei in Japan, the Hang Seng in Hong Kong, but it was Chinese equities that underperformed, down more than 1%. And interestingly, I wanted to point out Chinese bond yields as well because they continue to inch lower. The 10-year yield in China down again today. We're sitting at 2.93%. That's around the lowest level in about a year. And in foreign exchange, I wanted to point to the Kiwi, the New Zealand dollar, stronger against the US dollar, the big outperformer in the G10 space, up about 0.8%. And that is after the central bank said it will end QE this month. That is a surprise move. And now traders are saying maybe a rate hike will come as early as August. Here in the U.S., of course, we did get that hot CPI print yesterday, PPI on deck today, as well as more earnings from big banks. And where that leaves us is lower fractionally in the futures market. We're down just a point on S&P 500 futures after the index fell from a record high yesterday. But it was really the action in the bond market that got my attention because initially, off the back of CPI, we saw the curve flattening out. Then we got a 30-year auction that was weak. That led to curve steepening, long end yields moving higher. Today, though, moving back down 2 basis points on the 10-year, we're just shy of 1.4%, and the curve is flattening out once again, looking at the 530 spread. Also, the dollar had its best day in about a month yesterday. It reached the highest since early April, but it is weaker once again today, down about 0.1%, Danny.
Overall, a weaker day in Europe as well, Kaylee, more so than what we're seeing, as you pointed out, in the American equity futures. You have your UK indices falling about 0.5%, CAC 40 down 0.3%. You're really hard-pressed to find anything that's a big outperformer in Western Europe. Inflation is also the name of the game when it comes to Europe. And I want to delve in more what's happening in the UK, because UK stocks are down, but we have a very strong cable rate. Cable rate, it usually trades inversely to what's happening in the stock market, so that's up 0.25% versus the dollar. Now, not only did CPI surprise yesterday in the US to the upside, it happened here in the UK as well, coming in at 2.5%. Estimate was for 2.2%. So you have a UK front end of the curve that is perking higher, with hawkish surprises now being priced in when it comes to the BOE. So that is at 0.33 when it comes to your UK 5-year yields. But inflation across the board becoming a concern in Europe. You're looking at a Bund curve that is also steepening today by 5 basis points. And that, in turn, is giving a nice little lift to banks today. A Euro Stock 600 bank index that's up 0.7%. That is the outperformer in a day that is otherwise looking pretty soggy here in Europe, Francine.
Yeah, let's see if those increases are durable or not. Danny Berger there with a wonderful look at the markets. Now let's also look at what's ahead today. 8:30 a.m. Eastern time, we get U.S. PPI for June after that hotter than expected CPI reading yesterday. Then at midday Eastern time, we'll also get the start of Jay Powell's 2-day congressional testimony. This is the big one. Any comments on inflation, again, likely to be in focus. Before all of that, though, the U.S. bank earnings, we're expecting Bank of America first up around 6:45 a.m. Eastern time. Citigroup, Wells Fargo around 8 a.m. And don't forget, it's also BlackRock Day. So let's get the latest on those bank earnings from Sonali Bazak, Bloomberg Wall Street reporter. Sonali, thank you for joining us early. Yesterday was pretty exciting. Today we're expecting more Wall Street. And actually, they're beating on quite a lot of performance or quite a lot of metrics. But it seems that investors sold some of the stocks because they're focusing on the negatives.
Yeah, they certainly are. The bar is very, very high, Francine. And when it comes to Goldman Sachs and JP Morgan, where they fell short was largely fixed income and worries about an outlook for lending. So those are concerns we'll definitely share today. Investor expectations for fixed income performance at Bank of America and Citigroup are actually higher than they were over at Goldman Sachs. So the bar is very high. And over at net interest income, remember, we know that JP Morgan had reduced their full year outlook, and we're going to want to see whether Wells Fargo and Bank of America make a similar move. It's also very dependent on market performance. So there is room for that net interest income to fall even further than what the banks are saying this week. The other big issue is compensation and costs.
So if the bar is high then for the banks, how does it look for asset managers, Sonali, considering we have BlackRock today?
It's a great question, because when I talk to my sources, what they say is that the biggest competition they're seeing on Wall Street in terms of hiring is over at the investing space. So BlackRock, of course, is the biggest in that space. Wall Street is expecting BlackRock's AUM to rise by almost $500 million. They have been at a record over $9 trillion, so significant inflows. We're going to want to watch for Larry Fink's commentary. He's sounded concerns about inflation before. They're ever more significant today. From the banks yesterday, we've heard that JP Morgan largely thinks it's a tail risk, but they're not factoring it into their base case scenario. Are investors for BlackRock saying the same?
All right, Sonali Basak, Bloomberg Wall Street reporter, covering the asset managers and banks all day for us today. Thank you so much. And of course, tune in later today on Bloomberg to catch an interview with Bank of America Chairman and CEO Brian Moynihan. That's at 3:30 p.m. New York time. And that'll be followed by a conversation with the CFO of Wells Fargo at 4 p.m. Meanwhile, Bloomberg has learned that Apple has asked its suppliers to build as many as 90 million next-generation iPhones this year, a sharp increase from its 2020 shipments. For more on this scoop, we're joined by Debbie Wu, Bloomberg Asia tech reporter in Taipei. So, Debbie, this is an increase of about 20%. What does this signal?
So, clearly, this is up from last year's projection of 75 million or so at the very beginning of the launch. And this shows that Apple is expecting that consumers will, there will be a pent-up demand once consumers see their life return to relatively normal from COVID-19 outbreak last year. And so this year, while we are not expecting significant updates to the functionalities, this will be the second year that Apple offers 5G handsets, and then 5G is the new communications technologies that will help consumers stay connected either at home or on the go. So hopefully that this will help boost the demand later.
Debbie, thank you so much. Bloomberg's Debbie Wu there reporting from Taipei. Now on to the EU with this big climate deal that we're actually expecting to have details on today. It should unveil how it plans to become the first carbon neutral continent by the middle of the century, positioning itself as a global leader on climate change. Now, among the bloc's promises to cut 55% of its emissions by 2030, but actually from the 1990s, not from today. Our Bloomberg European correspondent, Maria Tadeo, joins us now from Brussels. Maria, this will touch everything from the cars we drive to how we heat our houses.
Yes, Francine, it's huge, and it is a monster even by European standards. We're expecting about 12 pieces of legislation to be introduced today. It changes, as you said, the way that we drive. It changes transportation, aviation. It also changes, of course, emissions. The focus very much on cutting down emissions 55% by the time we get to 2030. And, of course, the big aspect for the market, Francine, as you know very well, is pricing. We're expecting the European Commission to put forward changes in the European emissions trading system. This is the biggest one in the world. Of course, as you know, it's companies that buy and sell credits to produce. The criteria could be changed, more industries included in that. And of course, you have the big surprise that we're going to get. It's a carbon border adjustment mechanism, that carbon tax that could kick in order to prevent what the European call unfair competition from high polluting countries and carbon leakage. So again, it's a monster package. A lot of this, of course, still needs to be signed off by the politicians. So today we do get the proposal, but still a lot of details will be pending based on the politics.
Big changes. Bloomberg's Maria Tadeo, thank you so much. And I do want to take a quick check now on some stocks moving in pre-market trading here in the U.S. And I want to go back to that Apple story we were just discussing with Debbie Wu, because it did move Apple suppliers in the Asian session. And that is true, too, for Taiwan Semiconductor. And those ADRs are up about 0.4% in pre-market trading. Of course, this company gets about 25% of its revenue from Apple. Another stock moving to the upside is SGOCO, of course, the latest Reddit trader favorite stock. Wild swings. Granted, that's no surprise with these Reddit stocks, but it was up 720% in the 3 days prior to yesterday, then plunged 52% yesterday. Today, though, a bit of dip buying, up 14% in early hours. And one more stock moving to the upside as well is Newell Brands. This after an upgrade over at Raymond James. The analyst putting a $33 price target on the stock. That stock is up 3% in early hours to $27.30 a share, Francine.
There you go. We're all going shopping. Coming up next, Mathieu Savary, BCA Research Chief Strategist. We'll talk about the banks. We'll talk about some of the stocks that Kaylee was also going through. We'll look at treasuries and dollar. This is Bloomberg.
Lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
We see some of the reopening restart inflationary pressures coming through.
What today's CPI number tells us is that the market's going to switch to worrying about inflation again.
Inflation is front and center in everyone's mind, whether you're a bond investor or an equity investor.
The bond markets are sending a very clear message. This is not a big deal. It's transitory.
And yet, the increases are going faster for longer.
I'm not going to assume it's going to be transitory.
A large part of that will have to get passed on to consumers.
Investors should certainly prepare for the possibility the bond markets are wrong.
Inflation could be worse than people think. It's going to be with us through the better part of next year.
I don't think it's all going to be temporary.
This is not going to be music to the Fed's ears.
That doesn't matter if we have very strong growth.
Reaction there to the higher than expected U.S. CPI reading yesterday. Now let's get straight to our own indices.
Well, first of all, thank you for having me this morning. When it comes to measuring inflation here, we do some adjustments that go beyond removing just the food and energy. We do remove a bit the impact of the effects of the reopening, so removing obviously the used cars and trucks, but also things like restaurants, air travel and things like that. Right. And on this measure, yes, there is some inflation, but it's not yet particularly concerning. Measures also like trim mean CPI, median CPI also have perked up, which is inevitable. Right. But they do not point either to the extremely widespread inflationary pressure that the headline or core CPI are highlighting right now.
So, Mathieu, the reason we're trying to figure out whether or not it's sticky is because it's going to mean something for the Federal Reserve, and Jay Powell is going to have to answer to this print when he testifies on Capitol Hill later today. How high of a risk do you think there is of a policy mistake coming from the Fed?
The risk of a policy mistake is elevated right now, but the Fed has been very clear that it will look through inflation. Whether that's right or wrong is another matter. For what matters the most for the Fed at this point in time remains the state of the labor market, remains how quickly are we going to achieve an unemployment rate that's consistent with its definition of maximal employment, which seems to be an unemployment rate below 4% or so. For the time being, it's unlikely that the Fed will change its message despite the stronger inflation numbers from what was said at the last meeting.
So if that will likely be Powell's reaction, how do you account for the market reaction? We saw small caps crushed yesterday, falling more than 1.8%. I mean, if you told someone a couple weeks ago that higher inflation equals small caps going down, I mean, they probably wouldn't have believed you.
Yeah, so there is a few things there. There's obviously this idea that the Fed will continue to focus on the employment situation, but markets are also right to price in a little bit of tail risk around that. So that's point number one. Point number two is also what's going on outside of the United States, outside of the inflation pressure. We've seen some resurgence in the case of COVID related to the Delta variant. So that's unnerving the market. Yeah. And additionally, the Chinese economy is showing sign of slowing down a little bit because of the strong deceleration that we've had in the credit impulse. Now, the PBOC has cut the reserve requirement ratio.
So, Mathieu, what does it mean?
Yeah.
So what does it mean for where you want to place your money? What's the best bet on the markets right now?
So in the near term, it is to remain a bit conservative because you have all those forces that are pointing in various directions, and it's very tricky. So we are neutral on cyclicals relative to defensive in the market in the near term, but we are using this really as a moment to pause and look for the best opportunities that will be available down the road in the cyclicals. Because at the end of the day, we do believe that the Fed will be slow to increase interest rate very sharply. Any slowdown in the Chinese economy is temporary, and the COVID risks are also temporary. So for the time being, we are a bit conservative, but we are using this really just to buy cyclical assets later down the road. We like financials.
When it comes to cyclical assets, you like the financials here, even with the earnings we've seen this week?
Yeah, we do like the financials, but we are actually preferring European financials when it comes to the next leg of the rally. And the reason is that, unlike in the United States, the European financials are still priced as quite risky firms, while the reality is that we are seeing that NPLs are very, very well behaved. The Tier 1 capital ratios have been well rebuilt in Europe, and the economy is reopening, is benefiting from this phenomenon, and this will ultimately put some upward pressure on the German yield and result in a steepening of the German yield curve relative to the US yield curve. So we think that in this context, considering the pricing of European financials will be the place where most of the profits will be to be made for investors.
And they're certainly hoping for that to play catch up with where the U.S. financials are. Mathieu, thank you so much for joining us. That's Mathieu Saveret, Chief Strategist at BCA Research. Now, later today, Fed Chair Jerome Powell will appear before the House Financial Services Committee. We'll bring you full coverage of that. The testimony is going to be starting at 12 p.m. New York time. Here in London, it starts at 5 p.m. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua and Danny Berger in London. Matt Miller is off today. Now let's get the first word news. And Senate Democrats on the Budget Committee have agreed on a $3.5 trillion spending plan that would expand Medicare and provide more generous child care benefits. The legislation would carry most of President Biden's economic agenda into law without Republican support. The agreement is a win for Budget Chairman Bernie Sanders. He had pushed for the Medicare expansion. Meanwhile, a sometimes critic of President Biden's economic policy, former Treasury Secretary Lawrence Summers has met with the president's top economic advisors. Summers was at the White House yesterday. He and aides discussed the infrastructure legislation as well as the president's broader economic agenda. Summers has been sounding the alarm about inflation for months now. In China, state media outlets are blasting a U.S. plan for a digital trade agreement among Indo-Pacific economies. They call it a bid to protect American hegemony and the profits of tech companies. China Daily called the U.S.-dominated agreements, quote, shackles restricting trade. The Biden administration is discussing proposals for a trade deal as it tries to restrict China's influence. And Apple and Goldman Sachs are teaming up for a buy now, pay later plan. It would let consumers pay for any Apple Pay purchase in installments over time. Goldman would be the lender. The firm has been Apple's credit card partner on the Apple Card since 2019. So apparently, Danny, you don't need an Apple credit card to use this. I, though, use Apple Pay for pretty much everything at this point, a pandemic habit of mine, so this is an interesting one.
I do too, and let me tell you where I stand, Kaylee. Either you need to give me less things to hold, i.e. let me do everything with my iPhone, or you give me more pockets. You can't have it both ways, right, Francine? Women's clothing doesn't have enough pockets, so I'm fine with only having an iPhone. That's cool with me.
Yeah, on this, buy now, pay later, I've heard from a lot of banks this is probably the next frontier, and we saw Klarna actually with that crazy valuation out of Germany. Coming up, Marty Mosby, Vining Sparks Director of Bank Advisory. He'll be on with us shortly. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Francine Lack with Danny Berger in London, Kaylee Lyons in New York. Matt Miller off this week. Now, the focus, of course, is on the markets and on inflation. Just for a change, we focus on inflation after that CPI number yesterday was red hot, Danny. And, of course, once again, the question is, how will Jay Powell convince Congress when he testifies? First day starts today, but he has 2 days of it, to make sure that actually they understand that inflation for the moment is transitory. And then when you look at the bond moves, they don't 100% believe it.
Right, exactly. And when it comes to testifying in Congress, of course, one thing that's going to be top of mind are these different infrastructure bills, these different fiscal policies they're trying to put across. And that means a lot more spending from the government. So surely Washington doesn't want to hear that interest rates are going to be moving higher. There's definitely a political aspect to the moment we find ourselves in when it comes to inflation and the policy response, Fran.
Yeah, and Kelly, this is all playing out in the markets.
It is. I think the market is honestly a little bit confused, Francine, especially the bond market, which took essentially a round trip yesterday. Now, of course, the equity market, too, is waiting for that PPI print at 8:30 a.m. Eastern time, as well as more earnings from big banks. In Europe, the stock 600 is lower by about 0.25%. It's travel and leisure really leading the losses. Here in the U.S., though, futures have clawed their way into positive territory for now. S&P 500 futures up about 2 points. As I said, the bond market initially was a flatter curve yesterday off CPI, then a steeper curve off a weak 30-year auction. Right now, the 10-year yield is down about 2 points at 1.39% ahead of this morning's data, and the dollar is weaker on the day. As for some stocks moving in pre-market trading, I'm going to come back to SGOCO, the Chinese consumer electronics company. It has just had a wild ride. It lost more than half of its value yesterday after rallying 720% in the 3 days leading up to it. Today, it is higher by just about 4.4%. AMC is another Reddit stock that has been under immense pressure recently. It is down about 37% from its peak in June, lower by another 1.5% this morning. Apple, though, moving to the upside, that on a Bloomberg scoop, that it's looking to hike iPhone output this year by 20%. Also, Citigroup raising its earnings estimates for the company. And I just wanted to check on the financials ahead of the Bank of America, Citi, and Wells Fargo reports we're getting later today. The financial select sector SPDR ETF down about 0.3% in pre-market trading, Danny.
Kaylee, thank you for teeing my chart up just so perfectly.
You're welcome.
Just so perfect.
It's like I did it on purpose.
I know, I love that. Well, I am sticking with financials, as you may have guessed, and I want to welcome our radio listeners as well, and I will definitely explain to you the chart that I have up. But I think one of the most fascinating numbers of yesterday wasn't a 0.9% growth in CPI month over month. It's a 23% growth figure. So again, for our listeners, the chart I have up is the deposit growth at JP Morgan year over year. And so in the third quarter of last year, during the pandemic, when you have stimulus in the pockets of consumers, they're sitting on these high deposits, but it has remained high. And again, for our listeners, the last bar I have on here is a 23% growth for deposits at JP Morgan. Not only does that bode poorly for financials about getting that money to work, getting it to be loans and not deposits, but it also means when we're trying to decide what transitory means, how long this reopening trade lasts, there certainly is a lot of money that people are sitting on, Francine, that they could continue to spend throughout the rest of the year, again, adding just another inflationary pressure.
Yeah, and it'll be interesting to hear the other banks, actually, that are reporting today after we heard from a couple yesterday, JP Morgan, talking about how they see the recovery and possibly also talking about inflation. Now, outspoken analyst Mike Mayo of Wells Fargo remains bullish on banks.
Eventually, we expect higher interest rates, higher loan growth, higher traditional banking revenues, higher revenues from Main Street. And when that comes, that's the next part of the story. So do not leave the U.S. bank stock show yet. It's just intermission.
Well, joining us now is Marty Mosby. He's Director of Bank Advisory and Strategic Services as Vining Sparks. Marty, thank you for joining us. When you look at what we heard yesterday, which could maybe be replicated by some of the banks today, they're pulling in more money from, on the investment bank side as people do more deals and need more advisory clients. But actually, some of the trading was a bit disappointing. Does it seem that they're priced to perfection and that analysts will just focus on the negatives?
We are looking at a price point here that is much higher than where we were last year. And you really have to look at these bank stocks as very cyclical entities. Last year was all about credit. So you were building the provisions in massive numbers with the new accounting was forcing that up front, even though there wasn't any deterioration. And then over the last 3 quarters, we've been releasing almost all of that provision. Right. So all these earnings beats that we're seeing is really off the provision number, and it's just pulling that back down as we have seen no deterioration in that credit side.
But Marty, that is true. But also the investment bankers, the deal makers are kind of knocking it out of the park here. M&A, IPO activity, those fees, obviously pulling in a lot of revenue for these banks. How long do you think that can actually last?
Yeah, so the disruption we had last year and then pushing rates to a whole new level, a lot of this is debt issuance. A lot of that will be satisfied here in the next couple of quarters. So we are seeing the fee incomes that are supporting revenues. But if you look at JP Morgan's revenues yesterday, a year ago, it was $33 billion in the second quarter of 2020, $32 billion in the first quarter, and then $31 billion. So the trend is actually in reverse. And that's because of what's happening on the interest rate side. Low interest rates for a prolonged period of time is putting pressure on net interest margins. And the graph you just showed with all the deposits is creating competition for that lending, which is pushing pricing down for loans, which is also bad for margins.
So, Marty, then if it's an issue with loans, if it's an issue for net interest income, and as Kaylee pointed out, M&A is on fire with advisory type fees, is the trade now to look more to a Goldman Sachs versus a Bank of America that has less exposure to Main Street?
Not really, because when you start looking at Goldman Sachs, their number yesterday was all built on the fact that asset prices, the stock market, everything that you could invest in went up. So the inflation that you're looking for, and we're seeing in CPI, is fourfold worse when you look at the asset prices, commercial real estate, housing prices, car prices. Any of those assets are being driven up 20% right now. So their value in the sense of what they've invested in went up substantially, and that's what they recognized yesterday, which is why they had their beat. That's unsustainable as well. So really what we have here is a sugar high that's driving a lot of these fee incomes that's not sustainable. The bread and butter of banking is net interest income, and it's under pressure, and it's been under pressure for the last year.
But at the same time, credit levels, Marty, are okay, and that will continue. That will be supported by a recovery. And if you look at some of the consumer side, that's also seems to be supported, right? So does it depend on which kind of bank will do better?
Oh, there's a couple of things, yes. So you got that right. The credit cycle is done. We're not going to lose any money on the credit. But the interest rate cycle is what people are undercutting, and this is not really appreciating how much pressure that's going to create. The banks that you want to look at are the ones that have hoarded all this deposit growth in liquid assets, and that over the next year they can find either some incremental loan growth or opportunity, or they can find some way to put it back to work at a higher yielding security. So those that have that powder keg that can kind of push that out and begin to earn some money, or they have excess capital that they can repurchase or make M&A. So your M&A part will continue because their capital needs to be deployed. And so those that can deploy capital or deploy their liquidity are the things that are really going to make the difference here.
Marty, just a quick final question from me on the competition for talent, which seems to be heating up. Does that make you worried at all about the expenses these banks are going to have to face in order to compete?
Not really. When you look at what they've been able to do, moving much more to a digital platform, they will be able to kind of balance that out. Digital costs are coming down. As we're talking to many of these banks, their core systems, as they're going in and renewing them, they're getting some cost benefits. They'll have to go out. And really what you're looking at in banking is we are so digital now, we haven't trained many new bankers. And so just finding talent to be able to go out and do the things like originating commercial loans is really the challenge, but
Yeah.
it's not something they can't overcome.
Marty, great catching up with you. The quote of the quarter when it comes to banking, a sugar high that won't last. Thanks so much for joining us. That's Marty Mosby of Vining Sparks. And later today on Bloomberg, catch an interview with Bank of America Chairman and CEO Brian Moynihan. That's at 3:30 p.m. New York time. It will be followed by a conversation with the CFO of Wells Fargo at 4 p.m. Up next, we have Randy Kroszner, former Federal Reserve Governor, on a day where Powell is testifying and a day after a hot CPI reading. This is Bloomberg.
Estava há um ano sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo do Milton Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem pros amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, and Kaylee Lyons is in New York. Matt Miller off this week. Now let's get straight to the top story of the day. Bloomberg opinion columnist John Authers is also out with a must-read essay on inflation data after the CPI yesterday. Now he writes, German inflation after a bubble this year is actually expected to fall back to 1.7% in 2023. There's no sign of a new reflationary cycle there or in Japan or even in China. He argues whatever markets say, the experts are still more worried about deflation. Well, joining us now is Randy Kroszner. He's former Fed governor and deputy dean for executive programs at the Booth School of Business. Randy, as always, thank you so much for joining us. How difficult will it be for Jay Powell today and tomorrow testifying to Congress to convince them that actually inflation is transitory?
That's a challenge, given the very strong inflation report we've just had yesterday, plus the last 2 or 3 months of very strong inflation reports. But fortunately, so far, he seems to have convinced the markets, because even though we've had these very high inflation numbers and above expectations, both market expectations and Fed expectations, the 10-year rate has been coming down. Inflation expectations have been coming down a little bit, or basically been flat. And so he has convinced them. Not easy, but he's pretty deft at his words. So I think he's doing a good job.
Randy, I mean, there was something quite controversial in the John Authers piece in saying that actually they worries about deflation. I mean, are deflationary pressures now out the window? Is it difficult to argue that when you see, a 4% inflation print, but also 1.7, 1.8% in some European countries in 2023?
So I think this is the challenge going forward. So it's very clear that over the last few months and probably for the next few months, we're going to have some very, very high inflation numbers. What Jay and others at the Fed have argued is this is just transitory. We're sort of things really kind of fell out of the bottom fell out about a year ago, and we're just kind of making up for that. So it's really more of a one-time adjustment rather than an ongoing increase in prices. And then the question is, what's going to happen next year? Will the Delta variant or some other variant make us return to lockdowns and slow things down, and so then deflation is more of a threat?
Right.
Or will the vaccines cure all, and we're just going to be roaring ahead, people spending up all that savings from the last year plus all the fiscal stimulus? We don't know.
I'm so glad you mentioned fiscal stimulus because, of course, we got the news overnight that the Senate Budget Committee has agreed on a $3.5 trillion spending level. Powell is definitely going to face some questions on that on Capitol Hill today. I'm sure he's going to try and duck and weave his way around them. But from your vantage point, is that overshooting it on fiscal spending, and could that lead to more inflationary pressures?
He's going to be doing some tap dancing around that. I think it's very difficult to spend so much money so quickly in a way that's going to be productive for the economy. Because remember, a year ago was $3 trillion. Last December, everyone's forgotten about the $1 trillion last December. That's still a lot of money. And then almost $2 trillion in the rescue package, and then now another $3 to $4 trillion. You know, you put all those pieces together, that's almost 50% of GDP in a year and a half period. Even during wars, we didn't spend that kind of money. Now, this new package, not all of that's going to be spent immediately, but still, when you combine the fiscal stimulus with the pent-up demand and the high savings from the last year, if the economy can move ahead, so if the vaccines are effective against these the current variants and future variants, the economy is going to take off like a rocket, and that puts the Fed in a difficult position.
So is the Biden administration looking at giving this economy fuel that it does not need?
So I would argue that I think it's going further than it needs. Now, some of it is longer term spending, some of it is investment spending, which is totally sensible. But I don't think the vast majority of it is needed at this point. And I think sort of stepping back, making a very careful assessment of costs and benefits of what projects would be most effective would make sense. And so I think it has the risk of putting a little bit too much fuel on the rocket.
Well, given this level that Democrats are at least hoping for, whether or not it's necessary, does that mean that debt ceiling debates, as they approach closer, that deadline approaches closer, is it a risk event now, given the rate at which they're likely to blow through money?
Well, certainly the spending is really quite high, and it's not unique. The U.S. isn't unique in having very high spending, although these additional amounts are, I think, very different than what other countries are doing, particularly here in Europe. And so I think there are very important risks associated with that, and we'll see. If there is debate on this, with the Democrats controlling both houses of Congress, they may be able to make it through that debate more easily. But there may be some Democrats who are very concerned about these high levels of spending, and I think not unjustifiably.
Randy, what does a $3.5 trillion tax and spending plan actually mean for the rest of the world? Do they need to step up with their own stimulus, or otherwise really risk left behind?
I think the key thing from each country's perspective is, are there projects that make sense to spend money on? So are there bottlenecks in the economy where if you make an infrastructure investment, it makes sense? Some of the infrastructure investment is in our future generations, in education. That I think is something that's very valuable. And I think many countries should be thinking very carefully about that. Are they spending the appropriate amounts? Are they spending it in the appropriate ways? So I think just using this as an opportunity to think, we've got to be on the right path for increasing productivity going forward. How can we invest more both in our future generations and in physical plant? And that sometimes is done through tax incentives rather than through more government spending.
So, Randy, does that mean that the mantle needs to be passed from monetary stimulus to fiscal stimulus?
So I think you need to be careful about both, and I do think that if the economy continues to grow as we've been discussing, and we don't have challenges on the health side, certainly we can be taking off the foot off the pedal on monetary policy. But I'm still not convinced that we need more fiscal policy. I think Good infrastructure investments are useful at any time. But just spending for spending's sake or just trying to stimulate the economy even further, I'm not sure we need to do that now with such strong growth rates.
I am going to be making a tally of how many times Jerome Powell today says that it is not his job to comment on fiscal policy, and also how many times he says transitory. Thank you so much for your time today, Randy Krosner, Deputy Dean for Executive Programs at the Booth School of Business. And later today, of course, Fed Chair Jay Powell will appear before the House Financial Services Committee, and we will bring you full coverage of that testimony starting at 12 p.m. New York time, 5 p.m. in London. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lack with Danny Berger in London, Kaylee Lyons in New York. Matt Miller is off this week. Our very own Tom Keene now joins us. So with some great charts, he's co-anchor of Bloomberg Surveillance. And Tom, I'm excited because you've done a chart for me, bringing it back to the 1990s.
Well, it goes back to 1990, which means it goes back to the Asian crisis. There's been 3 or 4 Asian crises, but that is 1998. And the idea here is the dynamics of the moment, and particularly with the inflation scare yesterday, what it's done to the litmus paper of the world system, Francine, and that is the U.S. dollar. This is Asia DXY. This is Asia's Pacific Rim, ex-Japan, as compared to the dollar. With a plunge in 1998, we come back with a strong, sobered Asia. Then we roll over into weaker Pacific Rim currencies, and a nice rebound recently where we're really on the cusp of testing that. So much of that is the relative interest rates and the guesses of relative interest rates between here and the Pacific Rim nations.
And Tom, I'm also glad you're putting a bit of a spotlight, apart from, Jay Powell and, of course, the testimony on travel and leisure with the Marriott chief executive.
Well, we're going to have the Marriott chief executive on. I mean, it is a pandemic and we're coming out. I am going to lead with the, it's a hotel, maybe it's a motel on the shores of Venice
question.
where maybe they would have an interview with Christine Lagarde, and we'll see if he feels that your presence at the Daniele moved the Marriott brand.
Yeah, but that would probably move into the second quarter. I have to say, given the price of a cappuccino, it probably did move.
It probably did move, yes. That's called a Marriott cappuccino in Venice. This is a really interesting Wednesday. The news flow is extraordinary, Francine. Right now, where we are is significantly different than where we were at 8 p.m. last night for Global Wall Street.
Tom, thank you so much. Our Tom Keene there, co-anchor of Bloomberg Surveillance, with that important conversation, of course, on inflation, Treasury, but also the Marriott chief executive. Now, look at what else we're watching today. And Kaylee, data and Jay Powell.
It's all about inflation, Francine, both what the actual data shows us and then how Jay Powell reacts to it when he takes the hot seat on Capitol Hill later today. Of course, we get the PPI print at 8:30 a.m. Eastern time. The question is, will it come in as hot as CPI did yesterday? Economists are expecting the headline number at 6.7% on a year-on-year basis, 5.1% when you back out food and energy. But could there be room for an upside surprise? And is Jay Powell, even in light of that, still going to stick with his messaging that, don't worry, Danny, it's just transitory?
Just transitory. Yes, the T word, never going away. Well, Kaylee, while you're watching Washington, I'm watching Ottawa. And that's because the Bank of Canada has a rate decision today. And they were really one of the first central banks to come out and start talking about tapering. Well, today at 10 a.m., they are set to have that tapering. They're likely to cut bond purchases by a third. What we want to see here is them proving and giving the roadmap to the rest of the central banks that you can taper without a tantrum. So that's what I'm going to be interested in, Francine. I think Canada may be more interesting than the rest of North America today.
Yeah, Canada, smaller though, so easier also to manage temper tantrums. A lot of investors would argue. Now, this is what I'm watching. It's an exciting one. It's a big take, but it's also the front cover of Bloomberg Business Week. It's the Moderna chief executive actually talking about how they will use the mRNA technology against other illnesses, including flu, HIV, but also cancer. It's a fantastic, fantastic interview. And it also reminds us that Moderna, just a year ago, was not even profitable. So it's amazing how, in 12 months, it's now distributing 1 billion vaccine doses, and it could use this technology for many more illnesses across the world. We'll have plenty more on that throughout the day. Bloomberg Surveillance up ahead. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Consumers have been venturing out into the real economy, and they have been gradually putting that cash to work.
Americans were flush with cash. They didn't need to borrow, but that wears off.
When you look ahead to the next few quarters, we very much believe the economy will be still growing well above trend.
When things get really bad in markets, there's no doubt that volatility is going to spike.
We're just blowing away a forecast that was already revised up by a percentage point at the last FOMC meeting. So when does the Fed recognize that?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Jay Powell stepped right up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Wednesday morning with your equity market unchanged at 43.62 on the S&P. It's Chairman Powell's testimony, Tom, a little bit later that gets your attention.
Well, really front and center and changed in the last 24 hours. I really, John, would point to Mr. Summers' visit with the Biden administration and Greg Villiers publishing, very importantly, 2 hours ago in an eventful overnight, that maybe Mr. Summers was a bit ill-willed towards Mr. Powell. I don't know what that conversation was, but you know what? I dismissed it yesterday. Maybe Mr. Powell will be under significant scrutiny this morning by the legislature.
Do you think it's easier to sling mud within the tent than outside the tent?
Yeah, though that's the history
sense?
of economics here. But there's a lot of people, I think, in the economic game today that would just suggest Mr. Summers darkening the door of the White House the day before the Powell testimony maybe was a bit ill-timed.
That inflation print certainly spices things up a little bit later, Lisa.
Well, excuse me, Lisa.
It's okay.
I just was going to say John was way out front on this morning with the Englander research.
You're wearing your beige suit.
I'm fired up.
This is great. This is going to be a great show. I think that people are looking at the details, though, of that CPI report, John, and a lot of them do fit into the transitory message, and that certainly has been the message from the bond market, with yields lower today and bonds reverting back to a flattening curve after people digested that most of it came from the reopening kind of economy.
This is not the life people lead, though. They don't get to live by trimmed mean and strip out the stuff they don't like. They've got to pay the bills, haven't they? And I put out the Steve Englander chart that strips out all the reopening factors. And of course, for an economist, you want to pay attention to that. But Tom, for a lot of people, the pushback I had putting out that chart, for so many people, that's not the world they live in.
The Cleveland Fed, John, is expert at this, with a major hat tip to the Kansas City Fed as well. I live by the Cleveland statistics. There's other. It's a cottage industry, John, as you well know. And all I can say is I have huge respect for what people have to live, particularly service sector inflation, things like medical bills, things like tuitions.
Should we get a market check? What does the man from Del Monte say? He says yes. Your equity market, 43.62 on the S&P 500. I know you did. Unchanged. If you don't get the joke, please Google the man from Del Monte. In your bond market, yields are lower by 2 or 3 basis points.
Look at the euro.
138.96 and a break of 118 on the euro. Euro dollar back to 117.95, a break of 118 in the last 24 hours. Lisa, we're positive there, a little more than 1/10%.
Yeah, we're definitely getting new highs potentially today, even as you see that gloom persist, at least if you take the message from the bond market. I thought that Tom Keene was wearing his beige suit for the beige book that's going to be released at 2 p.m., but I will digress
cute.
and move on. All right, today, starting at 6:45 a.m., we're going to be getting earnings from Bank of America, followed at 8 a.m. by Citi and Wells Fargo. I want to see guidance on potential loan growth among consumers and corporations. What are they seeing? We didn't get that much, except for hope from JP Morgan that perhaps consumers would spend a bunch of their savings and actually start to lend again. They would be able to lend to the consumers who would borrow again. But we are not getting clarity in any way, and certainly Goldman Sachs didn't provide that in bulk. 8:30 a.m., this will be interesting. U.S. June producer prices. We're going to get the index reading here after yesterday's CPI data. I want to understand what the friction is here for some of the industrial producers. What kind of price inputs, how high have they gotten, and how much does that lead to inflation in the bottom line, in the consumer prices that we see? John, as you talk about when you go to the store and you see the sticker price increase, you're not going to talk about transitory factors and stripping out base effects. And at 12 p.m., as John was mentioning, Fed Chair Jay Powell testified to the House panel. Particularly curious about what he says about housing prices. I know that he and Treasury Secretary Janet Yellen are meeting on Friday to discuss this. How much will he indicate a willingness to curb some of the mortgage-backed securities purchases that the Fed makes every month in order to tame some of the housing prices, John?
Lisa, thank you. We've got to talk about a big tax and spend plan down in Washington coming together as well, Tom. Democrats coming together and agreeing on a $3.5 trillion tax and spend plan. This is some $2.5 trillion short of Senator Sanders' plan, but even he is happy with what's been agreed on in the last 24 hours.
Add $1 trillion or so to it for bridges, tunnels, roads, regular infrastructure. It's a social plan on top of infrastructure. And I just think the language that I've seen, John, in the last 4 hours as this plan rolls out is stark. This is going to be a battle. There are some that would say this is dead on arrival.
And this is going to be thrown at Chairman Powell again today, Tom, on what this means for this economy and the outlook. You might not want to go there, but this is the second audition, maybe the final audition for a second term at the Federal Reserve. Do you think that's a factor today, Chairman Powell?
Yeah, well, if you asked me yesterday, John, I'd say no. Folks, I really want to make clear the news flow on this Wednesday is extraordinary. And, John, when the facts change, I change. Yes, Powell's delicacies today will be there, and I think you'll hear a lot on social policy.
Joining us now, I'm pleased to say, is Christopher Marangi, Gabelli Funds Co-Chief Investment Officer. Chris, it's good to catch up as always, sir. Pricing power is a big focus for people in this equity market right now. Is it a big focus for you?
Absolutely. It always is. Listen, in deflationary or stable markets, pricing power is what a lot of fundamental investors like us look for. It's a nice to have in those kind of markets. It's a must have in an inflationary environment, which I believe we're in.
So how do you read the bond market reaction to yesterday's CPI print, given the fact that a lot of people were saying, look, we are in a new regime of rolling 3-month inflation that is the highest going back 4 decades versus it's just transitory?
It's a bit of a puzzle, Lisa. I don't understand it myself. Again, I think this is more than transitory. So far, the market is believing Chairman Powell. Chairman Powell has a very difficult job. He's got to walk the fine line between retaining his credibility and also helping to keep inflation expectations anchored, because really inflation expectations are very important here. Once the toothpaste gets out of the bottle, it's very difficult to put back in.
Well, but Chris, how do you use the bond market reaction in terms of your stock picks? The idea, can you continue with the reflation trade if the bond market isn't buying it?
Yeah, I mean, we look at the bond market as a source of data, but we're making our own judgments. We're listening to companies. We're hearing what they have to say about wage costs, about input costs. We heard from a consumer company yesterday that took down their forecast because they see higher input costs for longer. So again, we're making our own judgments. We do, of course, look at the bond market when we're making judgments about the financial sector. What does the yield curve look like? Will banks be able to make money if the yield curve stays as flat as it does?
Chris, we just saw some of these banks deliver massive numbers from the fee-based side of the business. And I just wonder how relevant a yield curve still is for these companies 10, 15 years after the crisis.
Yeah, obviously it depends on the bank. It depends on the institution. And we do think that M&A is going to be hot for a long time as well. And that should help institutions like Goldman Sachs and JP Morgan. But the core banking business is still to borrow short, lend long, and relying upon the curve. It's one of the reasons that we don't tend to overweight financial as much as our value peers do. But on the plus side, of course, we saw a massive reserve releases. Credit is extraordinary. Credit is really good.
Chris Maranghi, the hallmark of Mario Gabelli is I'm a shareholder, give me my cash. Do you guys suggest with the cash that's out there in financials, with the free cash flow in big tech and on in a boom economy, that you're going to see share buybacks like you've never seen before?
Yeah, I think we're going to see a pickup on that. And you know, we are very cash flow focused, obviously. Ideal world actually is not so much that we're looking for buybacks, but that we're looking for management teams to take that cash and invest it in high ROE projects. That's what we're paying management teams to do. But short of that, obviously, we'd love them to return cash, not so much in the form of dividends, especially given the prospective tax regime, but in the form of buybacks. We'd like to be the last owner of all the companies that we like. And I think we'll see more of that.
Hey, Chris, it's good to catch up. Just a quick one this morning. Appreciate your time, sir. As always, Christopher Maranghi there, Gabelli Funds Co., Chief Investment Officer, as we count you down to more earnings this morning from Bank of America in about 40 minutes' time, Wells Fargo and Citi shortly thereafter. And then we've got testimony from Chairman Powell, Tom Keene, at 12 Eastern, midday, a little bit later this morning.
We're going to get that testimony, but John, I'm going to be blunt. We're going to get the testimony of Stephen Major here at some point from Hong Kong. And John, you and I know he has a yield view different from the zeitgeist.
Long term, looking for that move back to 1%, though tactically short term neutral, and we can talk to him about that distinction.
Yeah.
But I'm with Lisa. The bond market reaction to the data was more interesting than the data yesterday. What we saw was the front end sell off and the long end was bid for about 5 minutes. It was a tale of two halves, wasn't it, Lisa? Because the second half of the day was really driven by a really weak 30-year auction. The supply really shook things up later in the day.
The idea here that people did push back at yields at the lowest level in months on the long end. However, the flattening in the yield curve has returned today. We see a return to sort of the dovish tilt. But you're right, and I think Stephen Major actually highlights this, that the reaction function from the Federal Reserve suppresses long-term rates, even if inflation does pick up more materially in the short term. He also points to the incredible overhang of debt and the fact that we are in a low growth environment. John, he's been right again and again.
A flatter curve is not a friend of the doves. Let's be clear about that. Steve Major, Global Head of Fixed Income Research of HSBC, will be joining us in a couple of hours' time. Tom, you looking forward to that? Can we get you excited about something?
Changed. I'm sorry, I don't care about it. I think it's a, you know, I don't watch it. I don't know what else to say.
What did you care about this morning?
But it's changed. No, I mean on the Powell testimony, I think that it really matters now after what Lawrence Summers did yesterday.
What matters most about it?
He is auditioning for another term, period.
Yeah. I think a lot of people agree with that, Lisa.
Yeah, I think that people agree with that, but he's going to reiterate the same message. He doesn't want to make headlines. That is his job today, and whether it's an audition or not, I don't expect a lot of market-moving information. At least that's his goal.
Yields lower on 30s, 2.0181%. We come in 3 basis points or so. Your equity market trying to get back to all-time highs at 43.62 on the S&P 500. From New York City this morning, good morning. I can't work out if you're grumpy or not, Tom. Going to feel it out over the next 20 minutes or so. Tom Keene, Lisa Brabitz, Jonathan Ferro, looking forward to this morning, and Chairman Powell testimony a little bit later. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Senate Democrats on the Budget Committee have agreed on a $3.5 trillion spending plan that would expand Medicare and provide more generous childcare benefits. The legislation would carry most of President Biden's economic agenda into law without Republican support. The agreement is a win for Budget Chairman Bernie Sanders. He had pushed for the Medicare expansion. In China, state media outlets are blasting a U.S. plan for a digital trade agreement amongst Indo-Pacific economies. They call it a bid to protect American hegemony and the profits of tech companies. China Daily called U.S.-dominated agreements shackles restricting trade. The Biden administration is discussing proposals for a trade deal as it tries to restrict China's influence. In Australia, Sydney has extended its lockdown for another 2 weeks. The country's largest city is fighting an outbreak of the Delta strain of the coronavirus. Stay-at-home orders for Sydney will remain until at least July the 30th. The city's already been isolated.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They are more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and Big Tech. Friday on Bloomberg Television and Bloomberg Quick Take.
Had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Everyone's forgotten about the $1 trillion last December. That's still a lot of money. And then almost $2 trillion in the rescue package, and then now another $3 to $4 trillion. You know, you put all those pieces together, that's almost 50% of GDP in a year and a half period. Even during wars, we didn't spend that kind of money. When you combine the fiscal stimulus with the pent-up demand and the high savings from the last year, the economy is going to take off like a rocket, and that puts the Fed in a difficult position.
The Fed is in a tough spot. That was Randy Krosner, the University of Chicago Booth School Professor of Economics from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market shaping up as follows. Unchanged on the S&P, advancing about a point on equity futures, 43.62. Outside of that, yields are lower again after a brief break of 140. Just a brief break. 139.80 is where we're back down to. Down a couple of basis points. Euro dollar trying to get back towards 118 at 117.96. Positive, Tom, by almost 0.2% this morning.
Yeah, you know, there's some movement in the market. I think the euro quote, John, is really important at 117.96.
Why is that, Tom?
It's just weaker. It's just slipped away. And you look at ADXY, BBDXY, the Bloomberg Dollar Index, folks, is broader, bigger, more EM than what you see in the traditional DXY. And they're both leading the way. It's a grind, John, but it's there. Stronger dollar.
Chairman Powell, midday. Lisa, I think it's going to be absolutely fascinating to see how he pushes through the questioning around that inflation. That data point coming just before this testimony is perfect viewing a little bit later.
Especially because, exactly to your point, people feel this. They feel it when they go to the store. They feel it when they buy airplane tickets. They feel it in everything that they can and will do right now. So there is a popular message, which he recognizes this and is going to monitor it more seriously.
Let's turn to Anne-Marie Hordern, Bloomberg Washington correspondent down in D.C. Anne-Marie, let's start there. Larry Summers inside the 10 in the last 24 hours. What's the take on that down in Washington?
Well, the timing is just so interesting given the fact that we had that red hot inflation number yesterday. And of course, Larry Summers has been so critical of the government's spending, the fiscal spending, the coronavirus, $1.9 trillion coronavirus package. Because of that, he was worried about fears of inflation. So the timing of it is very precarious, especially as Tom mentioned earlier, the fact that we're going to have Chair Powell testifying today on the Hill.
What do you make of that, Lisa? Do you think that does put Chairman Powell in a tough spot a little bit later?
I think that it raises the concern that even the White House is looking at inflation. However, it has been highly politicized. And Maria, I'm curious from your perspective, especially as Democrats come to some sort of agreement on a $3.5 trillion plan, how much inflation is looming as part of this debate and, frankly, as part of the pushback from Republicans?
That's exactly what you're going to hear from Republicans today. We've heard it in the past. When they ask these questions to Chair Powell today, they're going to point to the inflation number, I personally think, because we've seen it in the past, and talk about the fact that why should we have more fiscal spending when already we have an economy running too hot? And to Larry Summers' point yesterday, he was making the case that it's not just the economics, but the political sphere is also very similar to the 1960s, which preceded the red-hot inflation of the 1970s. So I think that's what Republicans are going to hone in on today. But the Democrats are saying we need these plans, and so much of them will help grow and expand the economy. But also, we should note, this is just an opening of the hard infrastructure, this $3.5 trillion. It's just the budget top line of what we could see. There's going to be days and weeks of wrangling on what exactly goes in the details.
And Marie, you talk about Larry Summers, and John and Tom rightly brought up this as the individual going to Capitol Hill. He is a Democrat. He served in Democratic administrations. He is raising the alarm about inflation. Are there Democrats that are increasingly concerned about this as they push back against Bernie Sanders' more ambitious plans? How much will that feature into this debate?
It's a very good point, and really that's where the power holds. It's in the moderate Democrats. They're going to be the ones that are going to be able to get this through for the progressives or not. It's the likes of Senator Joe Manchin from West Virginia, who also agrees he doesn't want as high taxes as the administration would like. He thinks that we have spent a lot. They want to make sure that they could pay for this responsibly, those moderate Democrats, and that's really where the power is going to lie when you see the debate on whether or not the Democrats are going to be able to get this over the line.
Well, let's go through the number, Lisa. 0.9 percentage point surge yesterday for core. But when you break it down, this was Bank of America, the breakdown. Used cars, 42 basis points of that push higher in core CPI. New cars, lodging, transportation services added another 28 basis points. You're almost there. This argument over transitory, Lisa, for me, we can argue all day about this, the definitions, the time frames, all of that. I think it comes down to something simple, and Mohammed El-Erian's done a ton of nice work on this. The price surge we see now, does it overwhelm the recovery? Does it overwhelm a sustainable recovery that would lead to full employment in the way that the Federal Reserve desires? And that's where the debate's got to be. And I think the Federal Reserve has confused that by introducing this word transitory, where there's this huge debate around what it actually means.
Well, that's the issue right now. And you're seeing this in the housing market. You're seeing this in a whole number of different areas. And I think that that's what you're seeing in the yield curve. And perhaps Fed Chair Jay Powell, John, will be able to address that later today.
Anne-Marie Horton, down in Washington, D.C. Anne-Marie, thank you. On the inflation debate, as we work our way forward to Chairman Powell's testimony a little bit later this morning, and Lisa, Chairman Powell is going to face a lot of stern questions, I think, perhaps from both sides of the aisle.
Yeah, but how concerned is he about disrupting a bond market that's pretty much asleep? I mean, you have people basically looking at this. If you have less than a 1.4% Treasury yield, just to give you a sense, the 10-year real yield is the lowest it's been, John, since this past February. We're talking about this dissonance between people expecting higher inflation and yields that are tamped down by a very easy Fed.
What's the more important bond market reaction from yesterday? The way we responded to the data, or the way that auction went a little bit later? There's two stories there. They're very different. We had the reaction to the data in the morning, then the reaction to the auction a little bit later in the afternoon.
But still, that yield on the 30-year auction was still very low. It's just that there is pushback at a certain level. I think it just muddies the question. And frankly, looking at the flows, how much is it foreign demand? How much is it technical versus a fundamental statement on the economy?
Let's touch base with this market. Your equity market coming into Wednesday, elevated, still close to all-time highs after a little bit of a retreat at 43.64. We're positive around about 3 points, up by 0.06%. In about 20 minutes from now, you should get some earnings from Bank of America. Then we'll hear from Citi, then we'll hear from Wells, and we'll hear about the business. We'll hear about investment banking fees, maybe soft trading, an environment that might not get better from here. But then we've got to talk about the bond market and what it means for these banks. 139.80 on 10s. Yields come in a couple of basis points. Your curve is flat at 2s, 10s by about a basis point. We were pushing 150, 160. People calling for 170, 180. Lisa, now we're back down to 115 on 2s, 10s.
And it raises a question of, can you invest in the financial sector at a time when you've got a flattening yield curve, especially because investors expect that we've already seen a peak in the yield curve steepening discussion, as the fund manager survey from Bank of America earlier this week showed.
Coming up, responding to those bank earnings and anticipating some of them as well. We'll catch up with Ken Leon, CFRA Global Director of Equity Research. Looking forward to that conversation. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. For our audience worldwide, what a morning we've got for you once again. I can't guarantee a repeat of yesterday, but we do have some testimony from the Federal Reserve Chair and some earnings from Bank of America, from Wells Fargo, from Citi. Your equity market 43.63 on the S&P 500, up a couple of points, positive 0.05%, and a push higher once again on the Nasdaq 100, up 47 points. Call it 48. We advanced there by a third of 1% for big tech. That's a dynamic we can talk about a little bit later. Big tech versus the small caps. That tug of war continues. 139.80 on 10s, yields lower by a couple of basis points from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply